I guess we have come a long way, and we have to finish. Even though those of us who are at the evening, we couldn't finish all the standard with one or two of them, but I guess we can still make it. Yeah. I hope that we will meet on Monday on those standards. For those within the weekend, I guess you are done with almost all the standards. Except the lease and foreign exchange. So that one, we'll try with some of the questions we'll try and go over that one, and it is okay. So what we have is that, as I told you, you have to pass the exams before you go. So you know that for the exams, the first question is going to be on consolidation. Going to be on consolidation, and the consolidation is 20 marks. You have to get your 20 marks out of that question. There are 5 questions. There are 5 questions, and you have to attempt all. What I do normally say is that we are saying that attempt all. You don't want a situation where you don't want to do it, because when you go to the field, you are going to face the problem, and you are supposed to solve it. So we are supposed to attempt. We are not saying solve the whole thing, but you don't have to be like you don't want to solve it. So try it. If you have not finished, that is okay. But if you don't even try it at all, it annoys them. That means that you have to fail for you to come back and write, because you have to at least attempt it. So it's better that you get the overview of the whole thing and attempt the questions. So the first question, as usual, is going to be on consolidation. Then the second one is on standards. So the standards will also be 20 marks. The standard will also be 20 marks for the meantime. That is for the second question. So about 4 or 5 standards, different standards will be there. And the requirement will be below 7 marks, 5 marks, 4 marks. It is distributed among them and such. So you have to solve that question too. Then the next one will also be on the final account. On the final account. So as we said, on the final account, it will also be the cash flow. The cash flow statement. Notwithstanding, when we were doing the IAS one, we said that it also includes the cash flow. It includes the cash flow. Even though the cash flow is also a different standard, IAS 7, it is still part of the final account. So it's better you know what is there for you to go and do. Then the next one will be on the interpretation. So this one is also 20 marks. It's also 20 marks. Then the interpretation will also be 20 marks. Then the final one, sometimes the interpretation and the last one rotates. So it depends. Maybe the interpretation will be question 4. Then the framework will also be question 5. So it depends. Then there's 5 will be the framework. And the ethics. That one is 10 marks. Then the standard comes again. We also have 10 marks. Or it could be 12 and 8, depending on the structure that the examiner wants to use. So the framework, if it is number 4, then the standard will be attached to it. So you get to a 10 and you get another 10 here. So that's why we're saying that the standard is about 30 marks. So that the framework and the ethics will take 10 marks. Okay. So please, as we have been doing, you have to know that you are going to pass the exams before you get there. So for me, as for the framework, I normally start with the interpretation because it will be that I'm familiar with the ratio, the analysis there. So I'll start with the interpretation. And with the interpretation, they are expecting that you get 15 onwards. You have to get 15 marks onwards. Then when I come to the framework, it's also theory. Then I'm expecting that you get about 8. No, you're going to get 7. You have to get 8. So by this time you have 23, right? You have 23 marks. Then you can come to the standard. This one is about 4 or 5, and this one is about 2 or 3. So you have about 8 standards in all. All these standards that I've done in isolation, 8 of them, 30 marks. So how much are you going to get out of it? 10. So let's say that with that, you are getting about, let's say 12. Let's say 12. So if the 12 is added, that means that you have 40. You have 40 marks now. Then 11, another 40 marks to get 10 out of it. So if you are going to start with the final account, frankly, if a cash flow counts, that is simple. That you have to get a lot of marks there. So notwithstanding, if in the final account and you get, let's say 8 or 10, then the consolidation 20. You also get about 7, or let's say 5. Why you have passed? So you have to pass before you get there. For the exams, you have to pass before you get there. So this one is going to be about 52 marks. And you have passed. You need only 50 to pass. So that's why we are saying that you have to attempt. You have to be serious and be working in the exams. Anything that comes into your mind about that standard, just write it. Even though you don't know the details of the standard, write something. I guess you have an overview of the whole thing, so you can write something. Okay, so I'm not expecting anyone to come back for us to teach the person. Or if you don't come here. Because those who wrote the last time, I don't think they gave up. Even though you are expecting to get your money, but please do well to pass so that we can all move ahead as such. So strategize and pass the exams before you get there. Pass the exams before you get there. Know what you are going to do. It's not like there that you are going to think, what should I do? No. You have to pass the exams. So even if this, you are not getting a 15, there are 2 marks there, so 13 there. You rotate. I mean, you have to pass. You really have to pass. I don't want a situation where students will be financing ICA. They have money, so why are you financing them? You come and write the exams, you fail, and you come and pay again, you fail. I mean, it's not necessary. So please, for FI, there's no way you are supposed to fail. There's no way you are supposed to fail. You have to pass. So just get prepared. If you just want to say, I'll do this, that, I'll do that, then you move on. When you get to the exams, you enjoy it. You finish and you smile. You know that you have passed already. So for about 50 marks going, 52, you can get it more than 52. Even though we want you to get an award, but you pass for us first. Later on, we see how the award will come. So for the 52, at least you have to get it. So whilst you are going to look at for the results, you are not even panicking because you know that your 52 is already there. You are just thinking whether it's going to be more than that or something. So please, it's not going to be difficult. So let's get our things in place to pass. I hope everybody passed. Or somebody is not writing discipline. Okay, notwithstanding. That means that maybe I'll see you. That means you're not right. So those that I will see means that they do not write. For those who write, you have to pass. You have to pass, please. You have to pass. So we are going to go through all of them in a little while again, so that at least you see that it's not that difficult for us to pass. It's not that difficult. But this is how it's supposed to be. So if you know that, and what they don't want is also that if you are answering question 4 as you have said, then you just have to answer all the detailed questions in question 4 before you move on to other questions. It's not like if there's any, sometimes there will be theory among the interpretation. What are the limitations? What are the importance of the ratio and this kind of little theory? If it is B, you don't want you to stop the B, you cannot do the 5 and then you bring 4B. What do you mean by that? So if you are not even getting it, leave a space. That's when you remember, you come back and write. So answer all the question 4 before you go to another question. If you are not getting that memory back, just leave that small space there and go to the other question. They don't want you to mix the solutions or the answers as such. Especially the framework is also going to be theory. So if you think that you are solving the standard and the theory you are not getting it, you leave a space. Go to the other question and come back later on. If you need more sheets, you have paid for it. We'll bring it to you. So just make sure that you leave the spaces and those kind of things so that you can fill in when the time is available. So that is how it's going to be. I don't think it's difficult. I don't think it's difficult. So we are going to pass. We are going to pass. Okay. So as we are going to pass, so let's start with the first one. The consolidated financial statement. The consolidated financial statement. And with the consolidation, as you have seen, we are saying that it's not difficult. And even if you are getting 7 out of 20, that one will be a little bit flexible. But we think that you're supposed to get more than 7. You have to get about 12 going, so that you increase this one. Okay. So what is there for you to do? There are only 2 questions. Either you are doing the profit or loss, and other comprehensive income. Or you are doing statement of financial position. Or you can also be required to do both. So sometimes when the both come, it means that the number of additional information will be lesser. It will be lesser a little bit. So these are the 2 that are supposed to be there. The last attempt, it was statement of profit or loss and other comprehensive income. The last 2 statements, it was financial position separately. So you don't know what will come this time. If they are rotating, that means that maybe this time the financial position. But you don't have to be, I see you can do anything. So they can repeat the same profit and loss and other comprehensive income. If they think that it was not well answered. Notwithstanding, we are going to pass through the same system to do all of that. So it doesn't matter which of them. So what is required is that so far as the company is a subsidiary and the other groups, that means that the financial statement is supposed to be consolidated. So you just have to establish whether there is a group. And if there is a group, you consolidate their financial statement. And it is simple for you to establish the group. So the first thing that I want you to do is to do the group structure. Get the group structure. So if there is a company, maybe 3 of them or 4 of them, whichever. Even if it is 15 of them, just get the parent company. And the parent company is the one that has invested in the other companies. So that is the parent company. So in the additional information, you see that he bought so and so shares in. We are talking about shares. We are talking about shares. So that is the shares that we want. If you are going to invest, you are going to be a shareholder and you have more than 50%. 50% on the equity share. That means that you can be a payer. So within the question, let's look for the one who is buying. So you see about 3 or 4 companies. There's one buying the others. Then that would be the parent company. So the name of that parent company will be at the top as you have seen. Then the other subsidiaries come. So even if it is 4 subsidiaries, you still have your 4 subsidiaries as such. And you are saying that it is either you consolidate or not. When you have more than 50%, you consolidate, or you don't have control. So you have control when you have more than 50% of the equity share in that investee or in that subsidiary. If you don't have, it means that you cannot control it. So the financial reporting date will be given. If it is 31st December, that means that as at that date, which of the companies is free controlling? Which of them? Then that you can consolidate. So you have to look at the reporting date in the question. Then you see whether they have more than 50% share as at that date. And that is what they need. So if it is, let's say, only 1 or 2, so maybe a subsidiary 1, they have about 70 or 60. So far as it's more than 50%, it can be even 51. Okay. So they have 70% there. Then you have to get as the date on which they acquire that 70%. So at what date? Then maybe if it is 31st. Actually, when it is financial statement of profit or loss, it is always going to be in the middle of the year. It will not be 12 months. Unless it is a combination of the two, then that it can be 12 months. So far as it's a statement of profit or loss and other comprehensive income, to be 3 months, 4 months, 6 months, it will not be 12 years. Sorry, 12 months. Maybe 9 months, 11 months, it doesn't matter. So far as it's not 12 months, that is how the question always comes. So you have to look out for the date on which they are part and the reporting date. Okay. So if it is in the middle, let's say first April. So if it is, this one is 2022, so they are part first April 2022. So that means that April is part up to 31st December. So you have to know the reporting date. How many months now? So you have to check. So it's going to be how many months? 9. Right? So 9 months ago. You have to put it somewhere so that you will not forget. Then if they also have any other investment which is between 20, that is greater than 20 but less than 50. Let me make it 50. It is greater than 20 but also less than 50. It will be like this. Greater than 20 but less than 50. If that is the case, it means that that investee is a subsidiary. Sorry, it's an associate. It's an associate. It's an associate. So with the associate, you are not consolidating the associate financial status. You are using that equity accounting as such. That means the profit that is coming from there, how much you are going to get out of it. So that one, you are not consolidating. Consolidating means that you are adding the assets and the liability to yours. But if you are not consolidating, it means that that will be a separate entity. And the income or the profit or the dividend that you are getting out of it, you account for it. That is the only thing that you have to do. So for associate, there are only 2 lines in the profit and loss and in the financial position, only one line item. So it's an income. So you know that you have the revenue, gross profit, the other income will be down there because we have already told that you have to bring your distribution cost, administration cost, and get the profit from operation. Then below the profit from operation, you bring the other income. So the associate income will come as at that time. Then when you go to the financial position, all the investment that you have acquired will also be there. So if it's goodwill, PPE, financial asset, all those things, then you bring the investment in associate. Okay, so that one is a little bit simple. But for the subsidiary, you have to add all the two together. Okay. So I don't think it's difficult. That is the only thing that you have to do. So the group structure is very important. And if it is an associate, let's say 25%, so associate one will also be there. You have to also do the date on which the associate was also acquired. 6 months ago, 3 months ago, or it could even be a full year. It will even be 3 years ago, it doesn't matter. So you just have to know the dates. So if it is acquired 3 years ago, that is okay. So please, for the consolidation, whether they have more than 50% at the reporting date or not, that is when you have to consolidate. And it is very simple. So as at that date, do they have control? Please, in the theory too, a lot of things can come in there. When do you consolidate a subsidiary? What are the exemptions? Even though they obtain 50%, they will not be consolidating. We have given you all the notes on that. Or you don't remember. Or when you go and read, you remember. So the theory is also part. It could be that somewhere we ask the theories. So you have to know the theories. When are you consolidating? Exemptions for consolidation is there. It could even be that explain control. Explain the equity account. So you have to, and then you have to go. You have to go and read all those things. Who is a subsidiary? Who is a parent? Oh, a little things can come in. It's like, I know that you have done it and I don't remember how to put it. How do you even start it? Yeah. As a matter I didn't serious, but that's absolutely never They are bad. So please, the little things are also important. So you have to look around it. In the framework, what is an asset and those kind of things also comes in. Contingent liability, contingent assets, all of that. They are all theories. You can come. So as much as we are doing the standard, the theory that is in must also be read. Who is a related party is also there. So in the standard can come and it's even a related party about few lines, and it is asking you all theory. So it's simple that you have to read around, get an overview of it, and you go. Okay, so what we require of you is that get a group structure first, then get the consideration. Get the consideration. So for the exams, when you put the paper, you are looking for group structure first. Who is the parent and who is the subsidiary, is the associate in it? You do all of that. 70%, 25%, it means that this is an associate, this is a subsidiary. The deeds, you get it, put it there. Then you come and do the consideration. So with the consideration, how much was paid to acquire the subsidiary? And normally, what I normally tell students is that the question is prepare the consolidated. So the first page is supposed to be for the consolidated financial statement. It's not there that you are going to do the group structure. No. So leave that first page for the statement of financial position or whichever question it is. If it is the two, it means that you have to do 2 pages. Then the third page, you come and do the group structure. That is for the workings. It's not like you do this before you can continue. It's not nice. The presentation is going to be something. So the consideration, how much was paid And we said that we have cash consideration. How to treat cash consideration. That is the cash that was paid to acquire the subsidiary. So let's say the consideration for the subsidiary. The subsidiary. One on the subsidiary. The cash paid to acquire the shares. So how much cash was paid to be given in the exams? Or it can be that it is saying that 2 cedis per share, 3 cedis per share, 5 cedis per share. You just have to multiply the cedis and the number of shares. Number of shares. So if it is 3 cedis per share, we just multiply it by the number of shares. But sometimes, since the percentage is there, then the number of shares may not be given. So you have to go and find the number of shares. So the percentage is 70% as you have seen here, times the number of shares. That is the shares acquired as at that time. And when you go to the financial position of the question given, you will see that since you know that this is a subsidiary, let's say the subsidiary is PA Limited. Then you go to the equity side. So within the equity side, you see that you will write maybe the number of shares or 0.25 per share, and the value of the shares will be there. Let's say 200,000. So if you want the number of shares, it means that you have to divide to get the number of shares. Because you multiply this one by a certain figure to get this. And we want the number of shares here. So if 200,000 is the value and this is the per unit, that means that when you divide, you get a number. If you don't understand, when you divide and get a number, multiply it with this one too again to see whether you are going to get this one. Then that you can multiply the 70% of that number, because you are only applying 70%, not all, to get the number of shares. I hope it's simple. You have to pass before you go. So you have to know what you are going to do. It's not like I'm going to think, hey, this, how do I get the number of shares? You have to know it before you get that. So if it is 0.5, you are still dividing. Sometimes the number of shares will be given. So it will not be currency here. It will be equity. Then the 10,000 will be there as the number of shares. There will be currency there. Then the value will be there. So it means that the 10,000 is the number of shares. So you multiply by the 70% to get the number of shares. And multiply by the per unit that you are buying for. So pass before you go. You have to know how to deal with it. Then you can also have share exchange. Share exchange. Yeah. I guess I did not put it on the platform. Okay, so please, you have to get a share exchange. Share exchange. So if there's a share exchange, it could be 2 for 3, 4 for whichever. If it is 2 of the parent for 3 of the subsidiary, that means that 2 over 3. If it is 4 for whatever, you just have to divide and it is okay. Times the number of shares again. The number of shares. So as for the number of shares, you have to get it. Times the number of shares times the share price or the market price of the period. market price of P. Market price of P. Because you are exchanging your shares for the subsidiary. So that price that you have in the market is what you have to multiply. So you get this one, then you multiply with the market price of the parent. That is how you also get the concentration if it is for share exchange. There can also be loan notes. If it is also loan notes, it is still going to be that we are exchanging for the notes. So that one to give the value over the number that will be given times the number of shares again. So you get the value divided by the number times the shares, the number of shares again. Loan notes. Example will be given, so it's not going to be anything like that. Then there can also be deferred payment. Like what I am answered, I won't go problem, but I don't think that there is any problem there. That the payment is deferred into the future. We are not paying it now. We pay it later on. So it will even be the cash and it is deferred. It will even be this and it is deferred. Whichever it is, it can be deferred payment. So if it is cash or whichever and it is deferred, it means that it is going to be paid in the future. So the same amount that you get here, then you calculate the fair value. You calculate the fair value. So the deferred payment is supposed to be on fair value. How do you get the fair value? How much you are going to pay in the future? So the future value times the discount factor. You get the fair value. So if you are going to pay 200 in 1 year time, or 2 years time, 3 years time, whichever year time that it is, then it means that you have to find the fair value. To find the present value. And the present value will be the person will give you the discount, what do you call it, the cost of capital. The cost of capital will be. So let's say 10%, 15%, 20%, whichever. It will be given in the exams. So if it is 15%, as the cost of capital, then you multiply this one by, you know the how to get 1.15 raised the power 1, if it is 1 year. If it is 2 years, raised the power 2. If it is 3 years, raised the power 3. Then let's multiply by the cash flow or the future value to get the present one. That's supposed to be the consideration. So you add all of that, whichever it is there, and you get the fair value. But what is here is that as you are paying the present value, it means that by the year end, you are supposed to pay the interest on the present value. That is the only thing which is a little bit different here. So you have to calculate another interest on this one. And the interest is still going to be the present value times the same percentage. That is 15 over 100. That will be the interest. So we call it unwinding interest. It's not anything that is difficult about it. So that interest is going to be part of the finance cost. Interest, the normal interest payable, we send it to the profit and loss account. Is it also? Then that interest will be added to the present value, and we state it also in the liability section of the financial position. That is the only thing. Okay. So when you finish with the consideration and you say that consolidate. So what you are going to do is you go back to the question and prepare your consolidated financial statement. Contingent is also there. Contingent means that the outcome depends on future occurrence, which the company doesn't have control. Right? So if you don't have control over certain future payment obligation, but you have to make that payment. And we also gave you the criteria for that. We are saying that if it is probable, if it is possible, when we are doing the IRS 37, You don't remember? You remember. So if your contingent liability is there, and if it's probable, you are saying that you do what? You provide for it. So depending on the sentence, if it is probable that they are going to pay the amount, that means that that figure is supposed to be there. Is it going to be in the future, 10 years or whatever? You have to calculate the present value. Get it? So that one to you is contingent liability, and it is going to be paid in 2 years' time. Calculate the present value. If the present value is easy to use the present value. If it is probable. But if it is possible, it means that you have to disclose it in the financial statement. You don't have to provide for it. So it will not form part of the consideration. You get it? So maybe after the calculation, then you write a note and say that there was contingent liability of this amount. That is a disclosure. But if it is probable, it means that it's supposed to form part of the consideration. But if the question comes, it means that it's going to be probable. So you have to find the person. So afterwards, we consolidate. And in consolidation, you are saying that add the profit. So if it is the income statement that is coming, so consolidated profit and loss and other comprehensive, give the heading. You start revenue. You know which of the companies that you are consolidating. So you bring the company's revenue figure, so the P figure, plus the subsidiary. And as I said, if it is the profit or loss, it's not going to be a full year. So you have to be aware and check. So with this one, it was 9 months ago. If it is 9 months ago, then the subsidiary times 9/12. We leave it there. The next is what? Cost of sales. Bring it. So write all that is in that question. Write them there. That one to the P plus the S times 9/12. As for gross profit, you cannot write what is there. Please. That one, you subtract this one before you get the gross profit. That's all you are part. You see, yes, it's yeah, no, you understand. The gross profit, you have to meet and subtract. Gross profit is there. So that's done. Put the line there and wait for the gross profit. Right? Then we bring the distribution cost. We bring the administration expenses. So then with the distribution, the parent again, S times 9/12, the same thing P plus S times 9/12. All of that, all the figures that are expenses, you have to write all of that to the end and leave a space for the distribution of the profit. So it will be long, a little bit long. Then if it is financial position, you still have to write what is there. Consolidate. Even if they say stop work for the 8, you get it. So that's why I want to do this one last, because it's going to take a lot of time. And if you start with it, it means that by 1 hour you are still on it. You hear them 1 hour is gone, and it's only 20 marks. When you are still there 1 hour. That's the way I have the if you just have to if you air conditioning there, you go to the game outside. So please, you start with the interpretation. For me, as I said, there is also reading time, so you have to get the help. So 15 minutes reading time before the 9. Use that one to do the calculation of the interpretation. Write the framework too. So when they say start with, you know what you are going to do. By 30 minutes, 40 minutes, you have finished about 30 marks. Then you can move on. If you don't do that and you go there late, you are going to be panicked. So you have to sit down around 8:30. Write your index number, whatever is reading time, you do it. Okay. So let's try one of the questions and know what is in there. and we are good to go. We are good to go. So the one that we sent, so we are going to do the first one, which will combine the statement of financial position and the income statement, so that any of them that counts, we can still do it. We can still do it. So the more question. I hope that you will supply the solution so that even though we will not be here, if we also move, we can still have the solution and be waiting or going. I don't think the FI is too difficult for you to do. Okay. So let's do the paradise and the kingdom and know what to do. But you have to be fast. You have to be fast. Because you know it's consolidation. So you are not just going to waste any time. You know it's consolidation account. So you start by writing what you have to write. And somebody read it for us. Yes.
Statement of
Question 1A, right?
yeah.
Requirements.
The requirement.
Oh, you don't have it? Do everybody have it? Okay.
Prepare the consolidated statement of profit or loss and other comprehensive income for Kingdom Limited for the year ended 31st December 2019. B. Prepare the consolidated statement of financial position for Kingdom Limited as at the 1st December 2019.
So we are supposed to do 2. And it says Kingdom Limited, so why are you wasting the time? You are just supposed to give us the Kingdom Limited. So you know that they have even stated the group at the one that we did how many up there. Okay, then let's do the broad, which is also similar. If that is what you did. The broad is okay. The C, 1C. Let's do the 1C.
Okay, prepare the consolidated statement of profit or loss and other comprehensive income for
Now one can answer more than cancel this.
and the 30th June 2016.
Okay.
Prepare the consolidated statement of financial position for Kingdom Limited as at 30th June 2016.
Okay. So there's broad, and that is a group name. We just have to broad group, the name of the group. Then the A is supposed to be statement. Statement of profit or loss and other comprehensive income for the year ended the year ended 30th June, right? And 16. Normally, it's going to be only one line, kind of. As for the financial position, it's going to be 2 columns. So with all of that, you have to know what you are doing. So it's not like you are going to create unnecessary columns. Okay. So you have to write it there. If you did the second one, you can still write so that the examiner knows that you're serious. But if you say that and they say stop work, the heading also counts. At least you get the heading. So we also have the B portion, closed group, broad group. And the B is supposed to be consolidated. These are not those consolidated, let's bring it. Consolidated statement of profit or loss. Consolidated statement of financial position. As at 30th June 2016. As at 30th June 2016. Okay. So your headings will be there. This is supposed to be two currency sign. Currency first one. That means that you are willing to start, at least. You can even write the headings at first. So you come to the next page to do the workings or the notes. To do the notes. And as we said, the first thing is to get the group structure. So let's go up there and come back again. So let's start from the top there.
Yeah, below are the accepting financial statements of broad limited and two investing companies, which also operates in the same level as the investor.
Okay, so broad limited and added two investing. So you see that there are three different financial statements there. Okay.
The first one is the statement of profit or loss and other by the year ended 2016.
Okay.
And the statement of financial as at the end of 2016.
Okay.
The following information is relevant.
Okay.
On 1st March 2016, Broad Limited acquired 80% of the equity share capital of Narrow Limited.
So please, we are looking out for acquisition of shares in all the additional information, so that it will give you an idea of how much Broad have in the other investee. So that is what we are looking for. Okay.
The consideration of two elements. A share exchange of various shares in Broad Limited for every five apart shares in Narrow Limited, and the issue of 100 cedi loan notes at 6% for every 500 shares apart in Narrow Limited. The share issue has not yet been recorded by Broad Limited, but the issue of the loan notes has been recorded. At the rate of acquisition, shares in Broad Limited had an aggregate value of 5 cedis each, and the shares of Narrow Limited had a stock exchange price of 3 cedis each.
Okay.
Broad Limited had earlier on acquired 2.4 million shares in Shadow Limited on the spot market at the price of 1 cedi 50 per share on February 1st, 2016.
Okay. So that one is also another share somewhere. So the first one is shares, the second one is shares. Okay.
Okay, so the second one is at the date of acquisition, the fair values of Narrow Limited's assets were equal to their carrying amount, with the exception of this property. These are the fair value of 1.2 million below its carrying amount.
This is not about shares.
Yes.
You can move on and check the other information.
I brought Group Limited policies, low value of.
So this is about revaluation. It's not shares acquisition. Move on.
Okay, the next one is sales from Narrow Limited.
So that is also not about shares. We move on.
And then the next one is Broad Limited sold goods to Shadow for 2 million.
This is also not about shares.
Yeah.
Move on.
Gross investment includes some available for sale investment that are increased in value by 300.
This is also not our shares. Continue.
Gross policies value the amount of dividend interest at fair value at the peak of acquisition.
That is also not our shares. So the first one is about shares. So we just have to know the group structure. The group structure. We start with the group structure. So you get this one find the group structure. So you have the PROM limited as the parent group, right? Then let's check which of them is a subsidiary and which of them is the other. So, okay.
Broad about 80% is the equity share capital of narrow limited.
So the percentage of control was given. So as for narrow limited and limited, it was 80%. You want the percentage to know the percentage of control. That is very important. Okay.
The consideration consisted of two elements.
Fine. We did the same that we can also come down a little bit and do the consideration so that we don't waste the time. So consideration. So this consideration is for narrow limited. It consists of what?
Share exchange of 3 shares in gold for every life.
So all that you know about share exchange, you have to remember it now. So all that you know about share exchange must come in your head now. And we said the parent subsidiary times the number of shares in those kind of times the share price of the parent. So we just look out for that in the statement. So how much?
So, exchange of 3 shares in broad limited for every 5 shares in narrow limited.
So it's supposed to be 3 for 5, right? Times every share in narrow limited. And how many shares are there in narrow limited? You have to go and check. So you go back to the financial statement of narrow.
Equity shares were at
The equity share at 1. So this one is 1. So even if you divide, you are getting the same answer. But please check. The price is per 1. So if the price is per 1, that means that the 5,000, which is the value, divided by 1. Because by the time that you get there, it will be 0.5. And you don't know whether you are supposed to use only the 5,000 because in class we are using the 5,000, which is the no. We have already divided, but you know that it's still 5,000. Okay. So that one will be times, we are buying how much? Only 80% of the, this is the number of shares, not the value of the shares, times the number of shares. That's why I was saying that we give them a name, say this 5,000. So this is that by 1C, right? So that it will be clear. Because you are getting the number of shares, not the value of the shares. So when you look at the equity, there are 5,000 in value, but per share is 1. So that per share 1 is that division that we have. Okay. So in order not to go and be somewhere, you can also do it this way. So times what? The share price of the parent. And what is the share price of the parent as at that time? Maybe you go down
share 5 cents.
of broad, because broad is the parent. So the share price of broad at the time of acquisition of narrow is
5 cents.
5 cents. I hope it's simple. So that is how we do share exchange to get a consideration. So how much are we getting? 12,000. That's simple. Some people can say, how are we using? The 500 is the 5 series. The 5 series is the share price of the parent. the parent is exchanging his or its shares with the subsidiary. So I'm giving mine for yours. So it means that mine is supposed to be used because my share price is given to acquire yours. So how much of mine am I trading for yours? So if mine is 5 cedis and yours is 2, it means I'm going to get 2.5 of your shares. You get it? So normally you have to use the share price for the period. Even though it could be that the share price of the period is lower, whichever it is. There's a number or the value of the share of the period that you are using to trade against the subsidiary. So all the time, if you are exchanging the shares, notwithstanding, you know that the parent share is going to be always higher than the subsidiary. But when you get to the exams and it's lower, you are still using the parent's price. Because that is the shares that we are trading for yours. So if I have cassava and I'm taking yam from you, that cassava value is supposed to be used against the yam. Get it? So the same thing there. So the exchange, my value, how much is my worth against yours? Okay. Any other question? Okay. The next one. So that is for the shares.
Yes.
Then what is another consideration?
The issue of 100 CD loan notes of at 6%.
So that is a loan note. Loan note is also there as a consideration. And what it is saying? It's saying what? 100 CDs. So 100 CDs. So the price of the share
Every 500 shares.
for every 500 shares. So this is a number, a share. So this is the value, and this is the number of shares that's supposed to be.
6%.
Okay, that one is the rate that we are going to pay as a finance. Times how much are we acquiring? So the same thing times the number of shares. So still is going to be 80% and 5,000 divided by 1 and so if you already have that one, you can still get. So it's going to be how much? This is your calculator supposed to be in your left hand. You are holding it and you are typing and you are writing, you are holding, you are typing. If you put it there, you are going to waste time picking it. If you are left it, you hold it in your right. Type and write. And sometimes you also type a different figure kind of. So if you are holding it, it will be fair in your hand as such. Okay. So that is also another consideration. Is there any other consideration for the acquisition of narrow? No. Okay. So it means that for acquisition of narrow, we have a total consideration of 20. 12,800. Okay. Then let's look at the other one. So this is 80%, and we have the consideration. And you also acquire certain shares in another company, right?
Yes. Earlier, acquired 2.4 million shares in Shadow Limited on the stock market at the price of 1 cedi, 50% per share on January 1st, 2016.
So S Limited, that is the Shadow Limited. They acquired 2.5 million shares. 2.4, okay. 2.4 million shares in there. So this the percentage was not given. So we have to go and find the percentage. So 2.4 million shares over the total shares that it has. How many shares that have? Go and check it in the financial position.
6 million.
6 million value. The value is 6 million. So let me give you this one. 100, right? What do you know the percentage of that position? So you can find so how much? 40%. If it is 40%, it means that it's an associate. So 40%. Let me have the day for the acquisition of 1st March 2016, and this one was earlier. Okay. 1st January 2016. It's in 2016. Okay. So this was about how many? What is the reporting period? I said 30th June. 30th June 2016. 30th June 2016 is the reporting period. What you are supposed to report in here. Okay. So if we apply this one, 1st March 2016, and we are ending at 30th June 2016, how many months will that be? 3 months. So 3 months ago, right? And this one, do how many months? 6 months ago. You have to know it because the timing is very important. So March is part, April is part, May is part, and the June is part. What do you have part of data of this or kind of stuff? As for this one, this is general budget, general 2. So calculator will be there, but you still be counting your answers out. Any question up to this time? Let's do the consideration for shadow. For shadow. What was the consideration? What was the consideration? One city. Per share.
Yes.
So it was cash consideration.
Yes.
So cash 1 city 50 pesos per share times the number of shares. We have 2.4. Was it 2.4? Yeah. 2.4 million shares. So we have cut some of them. So how much will it be? 3,000. How is something? So you have to get the 2. When you do this and you do that, then you can come back. You can come back. Any question? Please, for your group structure and consideration, you have to get it as fast as possible. Fine, if you want, you can also get a 40%. So if it is 40%, it's going to be 40% of the shares of Shadow. How many shares that? 6. You are getting it. So 40% will be 2.4. So you can do whichever. If it is given to you straight, you can do it if you also want. I guess you want more of the percentages down. And then having the absolute figures. Okay. Any question? So please, after this, straight to consolidation. So you are just copying back what is in the financial statement. So let's copy back. And you have said that the only thing is we will leave 1 or 2 spaces in there in case of emergency. Then you have to, it's not like you are bringing your templates aside, but you know that's not the template that you are using. So as you are writing, you leave the spaces to accommodate for other things. Okay. So the first one is what? Revenue. The revenue for broad 9,500 plus the it's only the subsidiary, and you have seen that now is the subsidiary. As for shadow, it's an associate, so we are not consolidating that figures. Okay, so we have 4,800,000, and it is also time apportioned for how many months? 4/12. 4/12. That is where the form is important. Okay. Then we have cost of sales. For broad plus times 4/12. Then what you have to get is gross profit. Then after the gross profit, you have distribution. Then 2,500 plus 1,200 times 4/12. Administration. Expenses. We have 5,500 plus 2,004 times 4/12. So you don't bracket it because you may be adding or subtracting. That's why you have to also leave that space down so that when the figures are not going to come into it below it. Okay. At times, when there is a impairment loss, it's supposed to be in somewhere here. If it is the question is saying add to any of the expenses, that is okay. But you have to leave that space too. You have to leave another space apart from the spaces that you are saying, so that any impairment loss can be there. Okay. So we go to leading to profit or operation. When you subtract, you have profit from operation. Then there is, so far as there is associate, you are going to have profit from associate. You have to put it there. Profit from associate. Then we continue. You can also have financials, or if you want to bring in profit before interest and tax, that is also lines and the dots. It's not necessary. Finance cost. The one in there is what we are still using. 100 plus dash. Okay. We have profit before tax. Then the tax. Income tax, we have equivalent 13,900 plus 8,400 times 4/12. And we have profits for the year. Other comprehensive recurring income, gains on revaluation, plan, return, comprehensive income, there's supposed to be other 4 lines. Other 4 lines. So the share of the profit, group share of profit for the year. NCI share of profit for the year, profit for the year. Now another group share of total comprehensive income. NCI share of total comprehensive income. Then you also put it again. So that is how you are supposed to do it. Straight.
The income tax figures are
One of the figures is one.
yes. It's a profit figure.
That's right. Income tax. 330. 900. And 16. Maybe I'm going to open ourselves already. So yeah, I'm mixing figures now. Okay, so you can still come and do the financial position too. The assets. Non-current assets. You have the property, plant, and equipment. You have that investment. Okay, let me add it before. To please out for this, you are adding all. There is no time apportionment. 18,300 plus 18,900. Then without investment. $12,600. You can add it. Current assets. It's only one line. Sorry. Here, there is also going to be the associate. The investment in associate is supposed to be one line item as such. And the goodwill. to leave a space. If maybe the hole is in there, it will not come at all. But let's leave that space there so that if there is a figure standing in the roots, you can bring it. So we have left a space for the window. Current, assets, current assets. Now 12,500 plus 2,400. And then we put down assets. Equity. And liabilities. Equity. Equity shares. For the equity shares, we said it's supposed to be only for the parents, right? So the value of the parents value is there. Non-revaluation. Revaluation reserves. Supposed to be for only the parent too. And that equity reserves. Supposed to also be for only the parent. Then we bring in the retained earnings. And since it's a group, we have non-controlling. Interest. You have to leave the retained earnings because we are going to do the calculation. The non-controlling interest, we are going to do the calculation to bring the final figure. Fine, if it's here, like you can write, because we are doing the cost of it. Right? So you have total, and you have the current liabilities. We have 6%. Notes. Which is per 1,000. Now the current liabilities. Then the tax will also come in. The current liability when it's added. And the tax funds are also added. That is not even there. So at least you are supposed to do all that. Funding the total equity and liabilities. So equity and liabilities as a final figure. You have to consolidate. We are going to do it. Okay. So after your consolidation, then you come and do the entries that you are supposed to do as such. So you can still go back to the question, start over again, and know where there has been changes and put it as right. Later, I accept every time. And if you don't take time, I mean, you are going to do all this for 1.5 hours, and you are still going to be there for 20 months. But for me, I don't want to do this one first because it's like you can do all of that. The additional information is not being called. You will not watch the time. The time is going for only 20 months. I'll give this and stop and do. And you will pass. Okay, so let's go over the additional information again and check. Let's go over the additional information.
So I think for one year, okay, let's start.
Start
So let's match 2016. Going to that 80% of the shares, share capital of Nairobi. The contribution consisted of 3 elements. A share issue of 3 shares in broad limited for every 5 shares in Nairobi.
Okay.
The issue of 100 cities loan note for every 500 shares applied. The share issue has not yet been recorded by the government, but the issue of the loan note has been recorded. At the date of acquisition, shares in God Limited had an value of 5 cities each. The shares of God Limited had a stock market value of 80 shares each. God Limited had earlier on acquired 2.4 million shares in Channel Limited on the stock exchange market at the price of 160 pesos per share on 3rd January 2016.
All right. So it says that we have recorded the loan notes, but we have not recorded the share exchange. And you said that when you wanted to acquire the narrow, they issue additional shares. The parent issue additional shares. And if you issue additional shares, it means that you have to increase your share here. It has not been recorded. So the shares for the parent supposed to be increased by the new issue of shares. You get it? It's a double entry. You issue the shares and you are going to get the assets and the liabilities from them. So you increase your shares and such as a liability, and the asset that you get is what we have already consolidated here. Okay. So we have to add how much shares? 1,000. If it is not recorded, there is a loan note here. Even if it is not here, we record it. You get it? No notes. You just add it if it is not recorded. Yes, in this statement of financial position. You just add it. Like this one, as you see, it's not recorded. You just add it. Any question? Apart from that, let's also look at this. Apart from that, since the loan note has been recorded, that means that let's go to the asset portion of the investment. The investment. You see that there is 12,600. There is 12,600. And when they recorded it, you know it's an investment that you have made. So it will be part of the investment that you have. And since this one was applied in the middle of the year, that means that when we consolidate, you are supposed to move from the investment section to consolidate the asset. And again, the associate figure, which is also in there, is supposed to be separated according to the standard. You are supposed not to account for associates as part of the investment. It's supposed to be a different line item. Then again, if you are also consolidating the financial statement, when you also put it under the investment, it means that you are double counting it because you are consolidating the asset now here. You are consolidating the asset now. So if you don't leave it here or you don't subtract it here, it means that you have consolidated the asset and you have also added the investment. So what you have to do is that you take away the investment figure, which is the 800, out of it, the one that has been recorded. That's supposed to have been here. That is the loan note. The loan note is supposed to be taken away because it's part of the investment as they have recorded it. Then the associate, instead of it being here in the investment, it's supposed to come here. Just that you are going to do all the calculations and put them here. So you are also supposed to take it out. What is the 30,600, which is the associate fee? So you see that that investment comprises with the loan note, which we have already included here, and the associate figure is supposed to be separated, not consolidated within. So a new line is supposed to be used for that investment. Any question? Okay, read that portion that is said that it has been recorded so that it will be simple for us.
The share issue has not yet been recorded by the document, but the issue of the loan has been recorded.
Let me. Okay, you let's meet too. There's an additional information that also buttress what I'm saying. So when you get there, I'll try to explain it again. I'll try to explain it and subtract it. Even though I've subtracted it, let's wait. Because there's health for sale, whatever. And we will talk about the total investment figure there. That the changes was due to something, not so that you know these ones. So when you get there, I will still come back to this. Okay. Let's continue with the additional.
At the date of acquisition, the fair values of narrow limited assets were equal to their carrying amount, with the exception of its property.
So it is talking about. It is talking about the net assets table that we also said that would be the other working that you have to do. I have to run this side. I guess it's okay. So the net asset table is the next table after the consolidation. So the net asset table. Net asset of which of them? The subsidiary. So it's only the subsidiary which is narrow. It can be two subsidiaries, right? So you have to be careful. It can be two subsidiaries. It means that when you are consolidating all the two subsidiaries. So this one they have 4 months, the other one they have 9 months. You are still adding. Okay. So we are taking the net assets of the first subsidiary, which is the narrow. So at acquisition, at reporting, what was the net asset? And you have known that the asset equal to capital plus liability, which is equity here. And if you want the net asset, it's going to be asset minus liability, which is equal to equity. So we are using this star to calculate for the net asset. So we are taking only the equity. So that's why we normally use the equity section of the subsidiary to mean the net asset. Is that okay? So the same system, the accounting equation. Okay. So the net asset at acquisition will be what and what. So you just go to the subsidiary equity section. Those items that you just have to pick it. What and what are there?
Equity share, retained earnings.
Okay, so the equity share. 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 Okay, so the equity share at acquisition and retain earning at acquisition. So at acquisition, what did they say about the net asset in there?
At the date of acquisition, shares in growing
Narrow. You want the narrow at acquisition at the date of acquisition?
The fair values of narrow limited assets were equal to the carrying amount with the exception of its product.
Okay, so what we are going to do is that the share which is in the reporting period was how much? That one, so far as there has not been any additional issue of share by the subsidiary, is going to be the same.
5,000.
So 5,000 here, and the same 5,000 here. Okay. Then for the retained earning, we have the one in the financial statement. What is the retained earning? 9,500 is there. At acquisition, we have to check whether the person gave it to us or not. Did they say that amount at acquisition, retained earning? No. Okay. They did not say it, or they said it. Okay, we will find out. Let's move on where we were reading.
At the date of acquisition, the fair values of narrow limited assets were equal to their carrying amounts,
Okay.
with the exception of its property. This had a fair value of 1.2 million below its carrying amount.
Fair value adjusted. Fair value adjusted. We are saying that the fair value was the same from here and there, but the property,
Yeah.
the property had an amount below. It was below.
Yes.
So if it is below, it means that we overvalue the item. Then, if you are doing the question, what do? You subtract. So you have to subtract. 8,200?
Yes.
Okay. 1,200.
This will lead to a reduction of the depreciation charge in cost of sales of 50,000 in the post-acquisition period.
Okay. So far as the property, you have to calculate depreciation on it. And earlier on, you overvalue it. So it means that you have calculated depreciation on that asset for a while. And it's saying that it has been overvalued by 50,000.
50,000. Yeah.
So if that is the case, the depreciation, normally the depreciation will happen after we have bought the asset, the whole subsidiary. So at acquisition, there won't be any depreciation because it's when the depreciation will start. But at reporting, that the depreciation will come in. So there is an overvalue of the property, and since you have calculated the depreciation on it, you have to take it out. You have to take the depreciation out. That also means that since you took the asset out, it means that you are adding the depreciation. What will be simple for us is that anytime that you subtract, add. Anytime that you add, subtract. That one will be simple. Even though if you don't understand it, don't go into. When you are taking, when it is overvalued, it means that the correction means that you are taking it out. Then the depreciation of 50 will be added. I hope it's okay. What it means is that the property, you said that it was so and so, meanwhile you have overvalued it by 1,200. That means that depreciation has been in the books. So at reporting, you have calculated 50 up to 50 accumulated depreciation in there, which is wrong. You shouldn't have calculated it at all. So the depreciation is a cost, and you have been deducted. If that is the case, and you want to make the correction, then you have to add it back. Do you get it? So that is what it means. That's why you add. But as I said, even if you don't understand anything, when the adjustment leads to a reduction, yes, add. When it leads to addition, subtract. So if it says that it was less, it was undervalued, it means that you are going to add a 12. This is why it was overvalued, so you are subtracting. Then the depreciation on it, you add. If it's the other way around, the depreciation on it, you subtract. So if it was undervalued, it means that the asset you are supposed to have added a certain amount, and we did not add. And the depreciation is supposed to be on it, supposed to be taken out of that property, which we did not do. So when you add, you take the depreciation out. So this time, we are taking it out, so we have to add the accumulated depreciation, which was cost back. I hope it's okay. Are you sure? But even if you don't understand the document, you just subtract and add. Just add and subtract. Then it says that the cost of sales is going to be what? The cost of sales is also going to be affected. Because the depreciation was part of the cost of sales here. It was part of the cost of sales here. So what do we do? It means that we take it off and we use it cover. We take the depreciation off. So the cost of sales has been increased by a depreciation which is supposed not to be there. Which is supposed not to be there. I hope you get the scenario. So,
In the reverse, if there was a overvaluation,
yes.
then that is what
You are going to add.
happened.
Yes. Yes. It means that you have been taking it out for a while. So you add it back. Or you do not even calculate it at all. The depreciation will be part of the cost of sales here. It will be part of the cost of sales. Because whilst we are doing the normal accounting, all the other costs plus depreciation, right? But here is the case that there was a certain asset which is supposed not to be there at all, but you have been calculating depreciation. So when you get to know that there is supposed to be a correction that you are supposed to do, what you do? That means that you take all the depreciation out. And this is what you have done. The other way around, if the asset is supposed to have been there and it is not there, that means that you omitted the calculation of the depreciation. So all this while you not calculate the depreciation for that asset. Then that you know now, go and calculate and come up. You get the scenario. And so that is what it means. The normal document. But fine, if you don't understand anything, when you add here, when you get here, subtract. When you add it here, when you get here, just go and subtract. It will be any answer. Okay. Any other question? So by the time that we go to one after the other, then you'll be done. Notwithstanding, that means that the PP, the same thing. It says that we have overvalued the PP. So it means that you have to subtract that PP out of it. And the depreciation has been calculated on it. So that also means that you have to add that depreciation. Right? We have overvalued it. So we have been calculating the depreciation, but fine, that will be the net figure that's supposed to be in the books to subtract. This one is supposed to have not been there, and we have included it in there. And then as we have included it, we have also added subtracted depreciation on it. So the net book value is a reduction, kind of. So if you are taking it off, that means that when you subtract it from that, you'll be taking the net book value out. Even if you don't understand it, what you did here, we will do the same thing in the PP. So we subtracted and we added. So the same thing, subtracted. Any question? I said, get the rhythm. How you do it. So anytime that there is fair value adjustment of any property, was it reduction? If it is reduction, that means that you have to add it back. And what will be the sometimes the depreciation will not be given to you, you have to go and calculate it. That it is 3 years, whatever. So you multiply and do the depreciation. This one it was calculated for us, so you think that exists. That's why you have to calculate it. So when there is a reduction, that means that you have to add it and subtract the depreciation. You go and subtract the depreciation here. That means that you have to add it and subtract the depreciation here. This one there is an overvalue. You have to subtract and add the depreciation. You have to subtract and add the depreciation. When you go here, you have to what? Subtract. Please, this one doesn't have any connection with this one. That's why we are saying that when you do the two in the final exams, any of them that comes, you'll be able to do it. So if it is only this one that you are doing, that means that you have to go and subtract the depreciation. That means this one will not come in. If it is only this one that you are doing, you have to subtract and add. Because it has been in the books and you don't need it, you take it out. This one has been in the book, you subtract and add the depreciation. The net effect will be the same. Okay. Any other question? You say I have 1 week or 2, 1.5, 1 point something. So Monday is week, then we are doing in the morning. So just rehearse how it is done. And it is going to go. Let's continue. Yes. This has been calculated. Cannot, will not be done. But on class as well, will go pretty down. So even if it is silent, it means that you have to do it. If it is silent, it means that they have, yes. If it says they have incorporated it, fine. That means that we are not doing it. But if it is silent, you still have to do it. So at default, you have to do it. Okay, let's continue.
So the third limit, gross group policy is to value all properties to current value at each year end. On 30th June 2016, the value of Finanacial property was unchanged from end value at acquisition, but the land element of broad interest property had increased in value by 500,000, as shown in other comprehensive.
Okay, so it is saying that the policy of broad is to value its assets at each year end, and the value of Finanacial Limited was unchanged from its date of acquisition, because when you consolidate, you have to assume the principles of the parent company, right? So far as Finanacial has become part of the group, you have to also adopt the policy of the company, the main or the parent. That is why it's saying that now they are adopting revaluation method for the, what did you say, the investment or the properties.
Yeah.
Okay. But there is a change of land property which has increased its value. Which has increased its value from that time by 500,000. Have you seen it? Okay. And that 500,000, how do you do it? When there is revaluation surplus as such, how do you do it? So PP, under the PP. So it's the same principles that you are going to use one after the other. Don't panic. Look at it and just apply it one after the other. So what do you do?
So you value that property and then you value that one. And then you
Okay. Yes. So you continue and you see that they have done it. It has increased the value as shown in the comprehensive income. So they are saying that they have done that one. Where is it? 500. Is it 500?
Yes.
So they said that they have done that. The revaluation has been taken care of. So they just want you to know, or you still want to do it. Okay.
So now it's going to affect the assets.
They have done it. So they said that they have done it. Yes. So if they have done this one, it means that they have catered for it here. No, as shown in there means that they have done it. And the double entry, if you have done it here, you have done it there. So don't pretend that they have not done it. You know how much they will do the double entry. So as shown in other comprehensive, that is what they have shown there. And it's even here. Yes. So if it is here, it means that they will get up for it. If the person wants you to do, that means that it will be only in the other comprehensive income. They want you to know. You don't want to know. And so people pray on home class for a year. Seriously. So action. So please read it critically as such to know that they have done it or not. You do it.
Sales from narrow limited to broad limited throughout the year and the 30th year in 2016 was 4 million. Narrow made a markup of cost of 25% of these sales.
Okay. So there is sales. And the sales, there is intra-group. And then there will also be PUP. Provision for unrealized profit. So take it again.
Sales from narrow limited to broad limited throughout the year, throughout the year and the 2016 was 12 million Ghana cedis. Narrow made a markup of cost of 25% of these sales.
Okay.
Broad limited had 2 million at cost to the broad limited had 2 million at cost to broad limited of inventory that had been supplied in the post-acquisition period by narrow limited as at 30th in 2016.
Okay. So we are saying that all intra-group transactions are supposed to be eliminated. That is what you said. So first of all, the sales must be eliminated. Then, if there is remaining stock in there, there is profit element in there. That one also is supposed to be eliminated because within the group, we don't sell to another person on profit. So let's try and get the sales first and take it out of the group. So what was the sales? The sales was 12 million. Throughout the year, right?
Yeah.
Throughout the year. So you have to be careful. Throughout the year. That means that when people consolidate only for 4 months. Only for 4 months. So the sales between the two groups is going to be times 4 over 12. By the time that they were not consolidating, they were still trading. But as at the time that consolidation comes in, it's then that intra-group comes in. You get it? So it's not all the sales that you have to eliminate because some of the sales was before the consolidation. We are only taking those after the consolidation period. Okay. So how much are we getting as intra-group sales? So that's supposed to be eliminated. So we go to the cost of sales and the sales again. So here, both. So the sales here that narrow half include the sales to broad. You know so? And narrow sold to broad. And the sales, the total sales for or revenue for narrow is 48. Divided by that, right? Then it includes the 4,000. So we take it out. Minus the 4,000. And when broad also acquire it or purchase it, it will also be included in broad's figure. You get it? So we also take it out. So the same thing taken out here, taken out here. So that there will not be any intra-group sales. That is the first thing. Then you also go and check. So the later part is saying that how much is left.
The broad limited had 2 million cost to broad limited of inventory that has been supplied in the amortization period primarily as at the 2016.
So as at the end of the period, that 4 million sales, there was 2 million left within the group. Okay, so the closing value is 2 million. Get it? What profit element is on that 2 million? The group is supposed not to earn it, so you have to take it out. So what was the profit element?
I suppose that the markup of 25%.
Markup of 25%. But this one is saying that it is cost to do broad. And it is cost to broad. So this is cost. And if it is cost, the markup of 25% supposed to be changed from markup to margin. And if it is going to be that, it's going to be 25. This one is supposed to be 25 over 100. And if you want to change, you add the numerator to the denominator. So it's going to be 25 over 125. If it is from here to here, and it is 20, that means that 20 over 100, when you are coming here, it will be 20 over 80. So you have to know that the markup supposed to be on cost, and the margin supposed to be on the selling price or on sales. Anytime that you are doing, you have to check whether it is on cost or on sales. So if it says margin, then the profit percentage is on margin. If it is on cost, the profit percentage is on cost. So you have to know which figure am I multiplying it. If it is cost, I have to change from that side to the other side. If it is on margin, I have to change. So depending on how it is stated. But then we are higher almost all the person that has come, you have to add a numerator to the denominator. It will give me the demonstrator. So when it says 25%, just use 25 over 125. And it's up. So 25 over 125. But we have to teach you how it is done. You have to be careful. If you are not more time, because no, without so the profit element will be how much? 400. Okay. So that 400 cedis, who is earning it? Shadow is earning it. Shadow sold the goods. So we said that when Shadow sells the goods, then it will also affect the PUB. It will affect the net asset table because it's the subsidiary who is the seller. And that 400 is on earned profit as such. So it's supposed to be taken off. Any question? I'm also going to do it in the other side, so you have to understand this one so that when I move there. And the profit element will affect, since it's now who is selling it, it will affect the net asset table. Subsidiary selling it. If it is the parent selling it, it will not affect the net asset table. To go to the retained earning. I hope so. But so far as the subsidiary selling it, it will affect the net asset table. Is that okay? There is profit element in the inventory, which is supposed to be eliminated. So there is inventory is here. Inventory figure is there. And there is profit element in it. And it is in the closing stock. The closing stock was deducted. You get it? To get the cost of sales, the closing stock was deducted. So if there is profit element as part of the total closing stock and it has been deducted and you want to correct it, what do? You add it. You add it back. Because more has been taken and it's a mistake. Let's correct it. So we add it. Is that okay? Alright. Apart from that, where again, you go to the inventory Inventory, where will the inventory be? The inventory. There is current asset inventory also there. That means that something has been added which is wrong. So we have to take it out. So do one just get the connection effective from it. So second, that is a closing stock. Read it. The closing stock. You have to state all the items at cost. At cost, because you are all group members. So if you give it to me, you don't give it to me at profit. You are all group members. If you give it to me at cost. But if you give it to me at profit and I have not sold the item, it means that the amount in there is overstated. It's overstated. And the inventory is supposed to be recorded at what? The lower cost of net realizable. And I have put profit on it, so I have to even eliminate the profit out of it. Or let me get the cost and compare. And when I get the cost, it will be lower than the 1. The closing stock there. 2 million. So the 2 million says that the profit element. So narrow makes a profit of 25% on its sales. So that's the 25% on the margin for narrow. And it's a group, so they also make another 25% aside. So you have to change from that markup to margin. This one, this figure is the selling price. The selling price. So this one is the 2,000 is equal to 125% because that is the sales. You add 25% on your product. So if you give it to me, it means that what I'm taking from you, you have already added a percentage profit. You get it? So this figure is 125 because you said that your profit is 25. That means that your cost is 100. So in the long run, you are giving it to me at 2,000. It means that this figure is 125%. You get it? So if I want the percentage, if this one is 125 and I want the 25, I guess I have to divide it and multiply by that. So that would be the profit element. And as you said, within the group, no one is supposed to make profit unless you are selling it to somebody outside. So what is the profit? The profit is 4. That means that since the subsidiary who is selling, you have to adjust it in here. And since that is adjusted, all those places that the inventory is, you have to go and check it and take it out. So the inventory is here. It was deducted. You have already deducted. So what you have to do, add it back. It is also here, part of, because it will be in the group, the main crop. So we have to take it out, the profit element. Then you do. So anytime there is any of them, just take it out. Oh, you ask. That's a good thing here.
So the 4 minutes approach in
Yes. The 2 million is the closing stock. That is not it. Now read it. You can see that. Read that where the 2 million is. Yes. So it is saying that within the whole year, Narrow Limited sold 12 million. Do you know what this is? 2 profit. Right? Okay, so that is the 12 million. But as at the time that we consolidate, how much sales has transferred between the two of them? Because we have only consolidated for 4 months. So if in the whole year we have sold 12 million and we have consolidated for 4 months, we are not going to take all the 12 million. We only take the 4 months ratio. And the 4 months ratio is going to be the 4 million, which is the sales. made within the group after the consolidation, then what do? You eliminate all the group transactions. So if you use the 12 million, it's wrong because the 12 part of it is before the consolidation. Part of it is before the consolidation. So you don't use the 12, you only use the 4. So you take it out, you take it out. Then you come again. How much of the stock are still remaining? So it says that 2,000 of the stock or 2 million of the stock is still with broad. Is it not what it says? 2 million is still with broad. Then you get the 2 million. Then you ask yourself, what profit percentage is on the 2 million? So to broad, that is cost. You wanted to add. Okay. And I want to ask you now, are you okay?
Yeah.
So the 2 million is with broad now, and it is cost to broad, but narrow sold it at a profit. So that 2 million coming to broad means that the profit element for narrow is on it. So how much is the profit on it? That now you calculate. So if it is cost for me, but it's a profit for somebody, then I can use this one to get the profit element on it. Okay. Yes.
So, is it that the same two
There shouldn't be profit on it because we are group members.
Exactly. Yeah, because you are
The profit element. Yes.
The remaining stock.
Yes.
I'm asking that. So the stock that can be sold.
That one, since it has gone to the third party, it will take its effect through the income statement.
So are you not supposed to subtract the profit?
That is what I'm saying, that it has already gone to a third person. So you have already taken the money. Right? We have taken the money. Individual component, preparing it account or account for the profit. But when it is consolidation, you don't account for the profit between the group. So that's why all into a group, if you give me a loan and there is profit element on the loan, I will take it out. You don't even have to give me a loan because it's just a transfer of the money. So when you go down there, it says that Broad gave a loan to. No, the loan will be taken out. You cannot give me a loan. It's like you are giving me the same. It's just a transfer of the bank account. There's no loan there. So anytime that there is a transfer of transaction, if they're supposed not to be intergroup, just transfer and just bring it. Let me sell it and give you back the money. That is all. But if you are preparing individual accounts, fine, I can say that your profit, give me back. So that I can also access my own profits. But within the consolidation, no profit. But when you are selling to the outside, then you can earn profit. So your sales here, if your sales here, part of it is the one that you give to me, you have to take it out. So that you know the actual sales to the third part. If the cost of sales, part of it is the one that I bought from you, you have to also take it out. So that you know the purchases from the third party. So even if you buy it, when you are giving it to me, give it to me as at cost. No profit. If I'm also giving it to you at cost, no profit. But when we sell it to the outsider, then the profit can be on it.
So that means that sales between the two entities.
There shouldn't be, yes. There shouldn't be.
But the remaining stock is
no. Wait. Since they send the goods to them, they added the profit. That is what the question is saying. There is a profit element already. They will send it to you at profit. That one is the individual account. But this time we are doing consolidation.
So if you are consolidating,
no profit.
And so why don't you subtract the profit
From
the intragroup?
no, since it has gone outside.
At home.
Yes, but the remaining stock is still with me, so no profit is supposed to be on it. They are told me, but they are coming. Also, you profit in their use. There were no part that said, even the 4,000, like he said, the whole 4,000, which the profit is included, we are taking it out. And they are enough for the closing event cannot be. It is a profit now. Even if there is profit on the 4,000, the whole 4,000 is taken out. So the profit will still go. But the closing event, employ, but profit, that's all. It is any profit in closing. It doesn't make sense. If it doesn't make sense, accounting is saying that it makes sense. So yeah.
Okay, so it is like a situation that maybe you mentioned and you tell me that a sale from being associated to the event will come at cost.
Yes.
Then there will be no adjustment.
Yes. So if it is done at cost, so if it was that transfer, the transfer will be eliminated because
Okay, so you then from the perspective.
yeah, that one will come. So, but if it is not part of the sales, if it says that now we transfer some of the goods to abroad, that one there will not be any effect because it's just a movement of the stock, right? But if it says that there is a sales at cost, it means that when they say it is a sales at cost, it will be part of the revenue of the one who is selling it or signing it. And it will be part of the cost of sales of the one who is receiving it. That one eliminates. That means that there will not be any profit element.
So the original
Is there? Yes. Okay. So depending on how it is stated. But so far as part of the revenue, take it out. It will be part of the cost of sale, take it out. Okay. But when you see that there is a profit element on it, do well to make sure that it is also gone. Okay. That are the goods services there. Going to yes, it will be on the closing. Any other question? Shall we continue? Okay. For me, as I said, you could even jump one step, one additional information, the next one, and go to the other one that you are conversant with and treat it. You are getting your math. But if you are going to start on the first one, you don't even see them. You see that the retaining and you have even not put it there. But people will be waiting to get the retaining and what do you mean by that? Why are you delaying? Just move on. If you don't understand the PUPM, just move on. It may be that some of them will be simple for you to get it. Don't be stuck anywhere. Okay, the next one.
In June 2016, God Limited sold goods to Shadow Limited for 200 million. 2 million. Sorry. That's achieving a profit markup of 25%. The entire consignment remained unsold and was included in the inventory of Shadow Limited as a 2016.
Okay. So it says that Roth rather sold to the associate. You see that one has not been consolidated. So there will not be any subtraction from the sales and those kind of things. Because we added the two sales. That's why we are taking the sales out. Because it's the same thing now, that's why you need. But this time there's a sales, another intro group, which is the broad, the period selling to Shadow, right? Yes. And how much is that?
2 million. As a profit of
2 million throughout the year or what? The remaining. No, how much is remaining there?
all the
So the whole thing is remaining. The 2 million is still there. We just have to also calculate another PUP on that 2 million. And what is the profit? What was the profit given? The same 25. So 25 over the 125 gets the 400. Right? The 400. And what do we say when a parent is selling to an associate? When the parent is selling to an associate, what are the entries that we are supposed to do? It's supposed to be in your head. to go to retain and where? Because they're supposed to be double entry. The cost of sales. The cost of sales. I mean, we got all. But notwithstanding, we are saying here that when it is like this, you just have to find the parent portion. The parent portion of the PUB. That is the first thing that you have to do. The parent share of the PUB when you are selling to an associate. And that parent portion will be 40%, right? 40%. Your 40%. So your 40% will be how much? 160. 167. And that 160 is supposed to be there for you. Until you go retain earning, it means that we are going to take that PUB out of the profit from the associate. And where again? We have sold it to, so it's with the what do you call it? With the associate. So it will not be in the inventory. You have to be careful how it is manipulated. So it will be in the investment in associate. It will be in the investment in associate. And it's a rubber retain and a balance. If you take it from here, you take it from here. So the accountant will balance. Asset will be equal to the liability and the capital. But you have sold it. If they have sold it to us, the broad, that means that it will be here in the cost of sales, which is the inventory that we are talking about. But now we have sold it to somebody outside. Even though associates is a little bit part of the group, but we have not consolidated their inventory. You have not consolidated their inventory. So if it is consolidating of their inventory, then it will be here. But now we have sold to them, they are outside the consolidation. So it will not be here. Do you get it? It will not be here. So what you have to do is take it here and take it there. Because if it affects here, it is going to be affecting here. The cost of sales, inventory high. They now affect here, but it's not with the group. The goods are not with the group. And it is not with the subsidiary, it is with the associate. The associate figure, another here. Associate figure, profit from associate. There's one here. Here. So before you get the profit from associate, you better hear from that. Then it will also still be here. Before you get this figure, it will be there. And before you get this figure, it will be here. I told you that this we don't normally bring the figures here to this side. So in order to do the correction, we take it here. We take here and apply all the income statement items. So instead of transferring the profit from here to here, we cater for it here. Then the other one will also be in here. Okay. Any question? But if it's the subsidiary selling, the associate selling it to the group, that means that it is with us as a stock. It is with us as a stock. Then it will come to the stock here. There is stock here, so the profit element has been removed. Then there is also stock here. It's supposed to be removed. Then the retained element will still pick up for it. Any questions? All right. And to ask. Then there is a new one there. Associate profit, which will still be the same. Okay.
Gross investments in goods.
So put it in your mind or write it somewhere. You are going to use it later. You will video in an edit. Okay.
Gross investments in goods and available for sale to residents.
Because this is the last part. So association sells the brand.
Okay.
So it's selling the subtracting from the
Group.
event.
Okay.
and the group within ends is a consolidated statement of financial position.
That's all.
And the P should be added to the cost of sales. Is a consolidated statement.
That's all. What about the other side? If
Parent sales associates,
yes.
it is determined that P as subtracted from the group within ends and the investment in associates in the consolidated statement of financial position. And the P should be added to the cost of sales in the income statement.
It's like it's repeating the same thing. The difference in which of them. Yes. And if it is added to the cost of sales, it means that it will affect the inventory. And so far as it will be here, it will affect the inventory. Because why is it added to the cost of sales? It's because of the inventory in it. That's why you are picking the cost of sales. Notwithstanding, let's do the double entry. So the general one is that if the associate is selling to the parent, that means that the goods are coming to the group. Definitely. The normal common sense. The Indian double entry, common sense. So if it is coming to the group, then it means that once the goods are remaining in there, it will be part of the inventory. Right? That means that we have to take it out of the inventory. That also means that it will be part of the cost of sales. That means that you have to also add it back. Because the closing inventory may have been deducted, so you add it back. Like we did with this one, the same thing. So PUP like this, we added back. So it's only, let's make it clear, it is only when the subsidiary sells to the parent, then that the goods remain in the parent's inventory, right? Is it also? So if you are consolidating, that means that it will be here. You have to take it off. And you have to take it also off out of the, what do you call it? The inventory in the current asset. Then that's the retained earning can come in. That means that it is not coming in. Right? Because it will be here and here. Definitely. But if it is the other way around, if the parent says to the subsidiary, the associate, it means that the goods is out of the group. The goods is out of the group. So it cannot affect the inventory. It will not affect the inventory. If you look at the solution, you see that it has also worked in a different way. So let's straighten it. What we have written. Let's straighten it. If the group sells to the associate, then the goods will be out. It will not be part of here. It will not be part of here. Right? But it will affect this one and that one. That means that it will also come and affect, since it's not going to be here, it's going to affect the profit on associate. Is that okay? So straighten it, write it again. Check it and put it right. When it is from parent to an associate, when it is parent to an associate, it will affect the investment in associate, the retained earning, and the profits from associate in the income statement. If it has been deducted, it will be added. Later on, we are going to break the PUP. Is a profit element, we are going to take it out. That they have earned unrealized profit. They have earned unrealized profit in here.
So it's not
Yes, but we are going to do the whole calculation somewhere and come and put the final figure there. Yes, we are going to add that. So it's going to be there in the retained earning. If it's the parent selling it, it will not affect the inventory at all. Because the goods will not be there in the inventory. So you leave the inventory out. If you leave the inventory out, it means that you are leaving the cost of sales out. You leave the cost of sales out. Because the inventory and the cost of sales goes together. Okay. Then it will be investment in associate, the earning, And since this one, we cater for the end, when you come here, the profit from the associate will be there.
This will not happen. Should I cancel it?
No, change it, change the rate.
But the PUP should be added to the cost.
Which of them? Is it the parent service? The PUP?
PUP should be added to the cost.
No.
So,
The PUP will be treated in the profit from associate. That is, it will be deducted in a way. When you get there, you are going to deduct. Then, it will be also in the retain and the investment in associate. For the double entry to be here and here. But the ones that is going to be here, part of it is also going to be here. And there's also one. Not even the watch. Okay, let's continue. As a reaction, what have you said? But to be here, there is a concentration. Not just but it's okay. Let's continue.
Gross investments include some available for sale investments that have increased in value by 300,000 during the year.
Okay.
The other equity reserve relates to these investments and is based on their value as at 30th June 2015. There were no acquisitions or disposals of any of these investments during the year ended 30th June 2016.
Okay. So it says that the broad investment includes some available for sale investments that had increased in value of trend. The other equity reserve relates to these investments and it is based on the fair value of that figure. So that is why I was telling you that let's wait till that time and collaborate with. So that investment, this investment is what it's talking about. That the 12,600, there is also some investment held for sale. That's what it's saying. And there has increase in value. And if there is any increase in value as in the fair value adjustment, it means that you are going to add that how much?
But so it says that the other equity
Let's do the addition first. Because the addition follows what you are saying. Okay. And continue.
and then the other equity relates to these investments and is based on their value as at 30th June 2015. So we have to go and add it to that one.
So the 300 plus another reserve here. So the fair value adjustment is kind of then you add it here again. It's supposed to be added to other equity. The classification is very important. It's telling us where we are supposed to put it. And it's also what?
Yeah, so there were no acquisitions or disposals of any of these during the claims.
Okay. So there were no acquisition or disposal
Of these investments during the year. The year ended.
Okay. So back to what I wanted to talk about. Then please go back to the earlier one so that where it has been recorded and it has not been recorded. I guess it is in the IR, right? Where the shares has not been recorded and whatever has been recorded. The additional information IR. And
So at the date of acquisition, the fair values of Nine investments were equal to their carrying amount, with the exception of its profits. This had a fair value of 1.2 million below its carrying amount. This will lead to a reduction of the depreciation charge of 50,000 in the period. Now,
Last time I tried calling you, but then you didn't answer. Yeah. Well, I think it's
So what you have to do is that if you have to always know that majority of time you retain earning at the beginning of not beginning. You only have to tell your one. No, you do it with the account that's right. The retain earning will not begin. So what you have to do is that you have to use the mathematics to get the retain earning at the beginning. We are saying that profits at n will be equal to the profits at start plus profit during the year, right? Profit during the year. During the year. So we are using that mathematics to do it. And profit at the end is how much? That is what the question gave to us. 951. And profits at the start wasn't given. That is what we want now. The retain and plus the profits during the year. So we are talking about now. We are talking about now. So let's go and check the narrow profit for the year. Profit for the year. That's how much? 6,800. So that 6,800 is the profit during the year. But all of them does not belong to the group business. The group business only took off 4 months ago. You get it? So the profit cannot be 6,800. It's supposed to be a proportion. I hope it's something. So you have to put it in your mind that it will not be given. So how you get it is to get the closing, get the statement, find out the profit, and just do the 7. So if it is 9 months, 9 over 12. If it is 6 months, 6 over 12. If it is whatever, you want to get a profit at the retained earning. So this is going to be 9,500 plus this one, sorry. This one you don't know. But you have this one. How much is this one? 2,266. So it means that you are taking it out here. 667. So we get 9,266. Why am I? The consolidation period. Yes. This one is profit after acquisition. Profit before acquisition. Profit before acquisition. That is the one that we have earned within the period. The total is the end, right? We don't do the beginning. But we have, this one means that they have earned a certain amount of profit before we consolidated. You get it? So this one will be the 8, and this one will be the 4. You get it? So the profit at the beginning is supposed to be there as such. Kind of. So when you add it to, it will even be that they had the main earning there. That one you don't even know. But the whole year, we only consolidated 4 months. So that is what we want during the period of consolidation. I hope so. So what's that? 2, 3, 6, 7 is okay. Okay. So equal to the profit at start. So how much are you getting? 7? 7. So that is the retained earning at the beginning. You get it? So you use the same style to do all the questions if it has. This one is given. If this one is not given, fine. But sometimes this one is also given. Then you just have to write it. If this one is not given, let's use this one, go to the income statement of that subsidiary and get a profit. I hope it's okay. Get a profit. And if it is time apportioned, use the time apportioned figure in the ratio. If it is 9 months, 6 months, 7 months, 4 months, whichever month is there, multiply with it. How much of that? That means that the profit will be the profit at the beginning. Okay. So here it means that this one is equal to 7, 2, 3, 3. Any question? Any question? Dear Joshua. So we have to find out the 2 and know the profits with acquisition profit. With acquisition profit. So the total will be how much? 11, 0, 9, 9. Four, 9, 5. So this is the net asset at the beginning and the net asset at the end. And when you find out the difference, it will be the acquisition profit. Some of the books will have the middle, the difference, and get the split. But if you also have the difference will be the acquisition profit. So let's get it. Acquisition profit. How much will it be? 1917. We are going to flow as such. So we have to do and get a good work calculation. Good work calculation. We are using which of them? Full, fair value, the full or proportionate. The full or proportionate. The are you using the fair value? Pardon? The question will tell us which one to use. So that is where you read the last but one additional information. The last but one additional information. Read that one and let's see.
The gross policy to value the NCI is fair value and the date of acquisition. For this purpose, narrow share price and attributes can be deemed to be representative of the fair value of the shares held by the NCI. Or was determined at the year end that 10% of the group was relating to that.
Okay, so it means that we are using the full depreciation, not proportionate. The question will tell you whether to use the proportionate or the fair value or the full depreciation. And good work aside. So if it is full, what you have to do is get the consideration, get the fair value of the NCI at the date of acquisition. Add them together and compare it with the net asset at acquisition. Is that okay? If it is not that, that means that you are comparing only the consideration with a proportion of the net asset at acquisition. So it depends on what the person will say. No, you are not getting the same thing. It's different than the So it means that the goodwill will be that the NCI will get part of the implement of the goodwill. And if it is proportionate, the NCI will not get part of the goodwill implement. That is the only difference. So let's do it. The fair value of the consideration that we have already done. So consideration. How much was the consideration for the acquisition of? So goodwill for Narrow Limited is what we are talking about. If there are more than one subsidiary, it means that you are going to do the goodwill for each of them. the consideration for each of them, you underline it aside. Okay. So consideration, we had the share exchange, which was how much? 12,000. Then we have the loan note, which was how much? 800. So the total was 12,800. I hope it's okay. So that is the consideration that we made. Any question? Then we have the fair value of the NCR. Non-controlling interest. So what is the fair value of the NCR? That is what it gives us. What is the fair value of the NCR?
So this balance share price advantage and the gain to the representative of the fair value of the shares held by the non-controlling interest.
Okay. So narrow share price is going to be the fair representative of the fair value. Then we have to go back and check narrow share price as at the time of acquisition. So let's go back up there. That was what you said, 3.5 or so, or was it 100? So if the okay, let me use the price. NCI 3.5 times how much share was not bought. How much of the share was not bought? That is for the non-controlling interest. You get it? So we did a group and then now the group bought how much? 80%. So the remaining share was 20%. You get it? And that belongs to the non-controlling interest. And that the price was 3.5. 2 times the 20% of the whole share of Narrow Limited. So you can have 20% of the 5,000, right? 5,000 over 1 if we sold the same thing. So how much will it be? 3,000. So we want to get the value of the shares as at the time that we are buying it. Or how much you pay for it. So when you add it, we have how much? This is 5. 16 grand. So this is how much we pay for it. This is the total that we pay for it. The payment is 12,800, but the remaining was 3,500. So the value of the Narrow Limited as at the time of acquisition is 16,300. Then we compare it to the net asset at acquisition. So there's net asset at acquisition. Net asset at acquisition. Where is this one? So we have 11,000 and 30. To give us how much? 5,267. So that is what we do. It means that the consideration and the fair value is more than the net asset. So we are paying for some invisible assets that we don't know. You see that? So that invisible asset is what we mean by the goodwill. So this is goodwill at start, as at the time of acquisition. Then we go on to see whether there's any impairment of the goodwill. Is there impairment of goodwill? So the question will tell you, if there is no impairment, we can also see that all the goodwill is impaired. That means that you write all of that off. Okay. So impairment. Impairment is how much? Okay. So impairment, you have to subtract the impairment, and it is 10%. So 10% of that figure is equal 5,267. So we get 526.75. Then you subtract, you get a goodwill at 10. You get how much? 47. 47. 40. 474.0. Right. So that is the goodwill which is left in the book. I hope it's okay. If it is proportion, it means that you are really going to take this figure and work, where is the net asset? You work only 80% because they are only 80%. The consideration 80%, then you are going to go. But if it is full depreciation, goodwill calculation, that means that you are going to take the consideration plus the NCI at the date of the acquisition. Then you subtract the full net asset at acquisition. I hope it's okay. So we just look at how it is done, you are good to go. So after you have done this one, you have to post the entries. And in posting the entries, you said here that if the goodwill is left, you have to come and use the goodwill. So if this one is working number, this one is working number 1, 2, 3. Shall I work it 2? Okay, if it is 6, you put it as 6. Now, put power working, so let's add the new working number. So you put the figure there 4, 7, 4, 0 point. Right. I hope it's okay. The final figure at the end. Then the goodwill. Impairment. If the impairment, they say that put it somewhere, that means that you add it somewhere. But throughout the question, they don't say that the good or are you supposed to put it in any of the costs? Goodwill impairment, the 10%. Okay. If it is not, then you can have its own line. Impairment of goodwill or goodwill impairment. The impairment of goodwill was 5, 2, 6, and I don't know, 0.7, right? Okay, impairment. 5, 2, 6, 0.7. This one. The 10% impairment. Any question? So it means that if you started with the goodwill opening, which is the 526, then you subtract the impairment and you get the closing. As if you have done it, the final figure will get, and that is it. Okay. Then we continue to do the other workings too. So the next working is
This assumes that you have a situation where the net asset exceeds
negative goodwill.
the indebtedness.
Yes.
So what
The negative goodwill, the standard is saying that you treat it as an income straight away. And that change, you treat it as an income. You don't treat it as a liability. You know the goodwill is supposed to be an asset here. But if it is negative, maybe you want to bracket it or something, and you don't have to also bring it in the liability. You have to come and treat it as a gain on acquisition. Like income from sale of something, like income on acquisition. That one will be easier. No. Because it's negative. So when you put it here, you have to bracket it. You have to bracket it to reduce the other assets, kind of, which is wrong. So the standard is saying that anytime that we get negative goodwill, so if the figure here is, where is it? This one is negative. That means that this one is more than this one. Then straight away, that figure is supposed to be other income. So after the profit from operation, you bring the figure there as a gain on acquisition of now. Fine, it's really, and the ruler you give me impairment. Impairment is when the asset is more than its recoverable. But if it is less again, and you have, there is no impairment or there is an impairment. No, you cannot. And we said that there are 2 assets that you have to do an annual review of impairment. They can come in the exams. Some which are the goodwill and the intangible with indefinitely useful. So at each year end, you have to do review of impairments. Any other question? So you are still going to go. So this one is supposed to be working number 12. So let me put it there. Then you go to reference number 4, which is a group retain N. Group retain N. If you look for good word now, I'm going to share because I will be using some of the figures here. As I'm not going to say table now, I'm not talking because it's also pivotal in the whole calculation. But please, just do it. As I've said, you will do it yet. Don't waste the time. So working number 4, group retain N. So with the group retain N, we said that you have to calculate for the retain N, which is here. So which is going to be working number 4. Which is going to be working number 4. And what are the items in there? I got this also past and some number, so you know what you are supposed to put in there. So the parent means that we are talking about growth. So let me put the growth there. Not limited. So growth limited, it's retain N, right? Growth limited retain N. What is the balance in there? The balance is 12. Okay. Now, what will be our offer? From the balance sheet, the retain earning for the group, which is broad. Obviously, the retain earning. So, only then you work find. Then what again? Go to the subsidiary. So we have the narrow, limited. Go to the other one, shadow, which is the associate. So all the retain and all the earnings that they have a portion in it, we are still going to add all of that. Okay. So under the narrow, which is a subsidiary, and then a narrow, which is a subsidiary, what are the things that we are supposed to put there? And how can you see anything in this class? So narrow limited, the group share of the profit that they have. So all that you have to do is get acquisition profit. This profit. This is narrow asset at the beginning and at the end. So what is the group share? So the group share of the profit here. And how much are they supposed to take? 80% of the 1917. I hope so. 80%. Now, only retain and group share. It's 80% of the post acquisition. It's like if you are able to do this one where you get the figure also there. How much will it be? 1,500.6. I hope it's okay. Okay. Do I know then? Is there any impairment of goodwill? Impairment of goodwill. So if there is impairment of goodwill, then you have to also bring it. Now subtract impairment is a loss. Impairment of goodwill. Impairment of goodwill. This we use the goodwill calculation, we use the full goodwill or the fair value. That means that a portion belongs to the NCR. If it is proportionate, all the figures are coming in. But if it is the full one, it means that the 10% part of it is going to go to the NCI. I hope it's okay. Because they calculate goodwill, then the NCI can. It's the impairment of goodwill, so NCI do. But how you do retain N until you group the employee. So we have to calculate again the 80% of the goodwill impairment. It was how much? 1, 4, 5, or 1, 5, 7. 5 impairment. So that's it. 5 to 6.7. 5 to 6.7. I hope it's okay. 20. 4 to 1. 6. Are you following? Okay. Then, if there is any sorry. If PUP is all, I say I can see group, and then it will be here. If the group sells to the subsidiary, then it will not be in here. It will come here. How will be okay? It means that the profit that you are getting from the subsidiary, part of it is like you have sold to yourself. So you have to remove it from here. Okay. So that one. But since it has taken itself here, it means that it will not come here. According to the production. Because in the they have multiplied the post-acquisition profit. So it's part of the whole thing. It's part of it. Okay. Any other question in there? So we are finished with what we are supposed to do under there. So let's do the shadow. That is the associate. So what is the group share of the profit from associate? Group share of the profit. Group share of the profit. So we have to go back and check the profits of the associate. How much is the profit from the associate? So we go to the income statement of the associate and check. And the group will take how much? What percentage? So 40% of the 6,800. But please, the 6,800 is for the full year profit. And by the time that we bought the asset, the time that it became an associate, so we cannot earn the whole 40%.
But the associate was for the full year.
Are you sure?
Yeah.
Check if there is a group structure.
Okay.
I hope it's okay. So just write the portion that you have to share, give its portion to it. That is okay. We are in the answer. So please, sometimes, as I always say, you could even be that you'll be able to do this one. Do this one then. The table. After the consolidation, and you think a whole lot of things are disturbing you, I will write it in and this balance will be there. You don't do any calculation on it. This profit will be there. You just check the number of months that you have bought the associate. Just write it and calculate it and put it there. None of it will be cool. And there are some things that you don't have to struggle and get. If this one is what you don't know and that and this and that, this one can do it my hand. No JP. You get more than half of the marks. But if you sit there and you come and complain, you're just standing present. How much? 6, 1, 7, 6. So just be working. This one that will come and just write it. Then he said that when the shadow was selling to the parent, the PUP will come here. And the retained. So the PUP shadow was the seller. So it will not be in the index. If that is the case, it will reduce the profit. So that profit that you are saying that you have earned, there are some that you sold to the subsidiary, and it is part of the profit here. That means that you have not earned that profit. So you have to eliminate it. And that is what we are saying. So how much are they supposed to eliminate? It was 400, and we said that 40%, right? 160. So 160 must go out. I hope it's simple. Anything? Is that side okay? All right. So I guess that is all for that. We just add them together. So you're very one and everything here. You can add this one, and that will put this out also here. Subtract this one, and subtract this one, and add all that. It's the same thing. But I do eyes on this of time. Until I am not that anymore. 1, 5, 2, 1. Yes. Yes. So we are saying that if you are sold to the person, a profit element from that company, you are earning part of it. Right? You are earning part of it, and the goods has not been sold to a third party for you to earn it. So that profit element, which is still in the books of shadow, you must remove it from the profit that you are earning. So you share the profit, all right. Now part of the profit is also there in the PU. So you take it out. Okay. Any other question? I'm saying that you shouldn't lose to me, right? But the profit that I'm also getting, you are also getting part of the profit. So if you show the goods to me, and there's profit element on that goods, and it is still with me. So when I send you the profit, it means that that profit that I'm giving it to you, part of it is not earned yet. Because some of the goods are still with me. So that section of the profit which is not earned yet must be removed from the profit that you are getting. And that is the big profit. And if it's still you sold it to me, it is still going to be the same thing. As for the retained earning, it will still be there whether this sold to him or the other sold. It depends on whether it will be in the inventory or in the investment in associate. That is where the problem is. If the associate sells to the parent, then it will be in the inventory and the cost of sales. If the parent sells to the associate, it will be the investment in associate, not the cost of sales and the inventory. But as for the retained earning, it will still be there. In any of them, it will still be there because it's your earned profit. I hope it's okay. So the double entry is that if it's the parent that is selling, investment and associate and the retained earning. But if the associate which is selling, it will be in the inventory and the retained earning. If it is in the inventory, it will be in the cost of sales. So far as it's in the inventory, it will be in the cost of sales. Okay. The next, this is question number 4, right? So 4, the figure will be there, and I'll just have to bring it. This 1, 5, 2, 1, 2.24. Then you continue. But again, you have to also go and calculate the NCI. So the NCI, let me bring this here. The non-controlling interest. Question number 5. How do you calculate the non-controlling interest? This one. Retained earnings. And that is also. And so the Finanacial data. 15, 2, 1, 2, 1, 2, 4. Okay. NCR. How do you go to calculate the NCR? This is at fair value. At fair value. If it is proportion, you have to bring the proportion. If it is at fair value, you have to bring the fair value, depending on whichever that it is. But if it is at proportion, you can just use this one and calculate the 20%, 20% of it, and you are done. But if it is at fair value, you have to start the fair value at acquisition. So the fair value at acquisition. The fair value at acquisition. How much was the fair value at acquisition? When you're dealing with goodwill now, you just go and pick the value. How much was it? Goodwill side. 3,000. Then you share what is the portion of the share of profit. NCI share of the profit. NCI share of this acquisition profit, right? This acquisition profit. And they are having how much? 20%. 20%. So 20% of this acquisition profit in 2017. 2017. 8.4. You see that it's almost the same pattern as here. To get the fair value that you use in the calculation of goodwill, the profit element in here, their portion, that will be 20%. And since they were also part of the goodwill calculation, then they have to suffer the impairment. So we learn the impairment on the impairment of goodwill. Impairment of goodwill. So how much is their portion of the goodwill impairment? Still 20%. Of the impairment, 526.7. 526.7. 105.34. Then you add all of that together. 105.34. Okay, so the total will be the total 77.6. So it's 0.06. And it's one. No, you are adding for that. Sorry, this one is this subtracted. It is subtracted. The goodwill impairment is a reduction. Okay. Any question? Any question with that? That means that we are filling up. So the others you can still fill it up. So by the time that you finish, some of them there has not been any calculations, you will be added. You will not calculating for the routine and whatever. Because some of the items, there was nothing in there here, there was nothing in here, there was nothing in here. So you just have to be added, and you are good to go. At least, why you be below? You don't have to wait and wait. The next one is the investment analysis. Investment analysis. And we will come there. Investment in associate. That is working number 6. So this one can be 5. So investment in associates. What was the cost of the investment at the beginning? The cost of investment. How much do we buy the investment? That is, the cost will be the consideration of the firm. The consideration. Let our 600. The cost is the consideration of the fair value at the time of acquisition. Then you put it. Okay. Then, what is the group share of the profit from the associate? Group share. Group share of profit. Group share of profit. So what is group share of profit? So you just have to go back and check the profit. And it's giving here to where is it? 1.67. But if you have 40, you can still do 40% of the 6,800 of 60 over 2 or 6 over 2%. The same thing. Okay. So we have 1360. Then there was PU. So PUP, which is still the same amount, or you can still calculate 160, which is subtracting. 160, which is subtracting. Okay. So that is all that is there. So you just have to follow the written and it is okay. So the difference we have 4,800. So investment in associate, working number 6, 4,800. 4,800. Then you can also come in and bring the profit from associate. So the profit from associate will be this portion. Or even if it is here, the cost is not part, it's only the profit. So this, the two of them here, will be the profit from associate. Or you can bring the fee here, the return and from the shadow is the associate. So the two figures there will be the profit from associate. I hope it's okay. So either you take without the cost, that's below the cost, or the other items are part of the profit from associate. So when you subtract, you get what? 1,300, right? 1,200. So that will still be 6. Sasa. So let's add them. Okay, let's also do this one. The profit here, the NCR. The NCR share of the profit and the group share of the profit. For the NCR, you get it. So when you get the total, you subtract the NCR and get the group share. So you only get the NCR and the other one will be okay. So you still come to the NCR. NCR. This is the value. This is the value, let's say at cost. But the remaining will be the profit. Remaining will be the profit. So we just add the remaining. This one is negative. This one is negative. So subtract it from the other one. That means that you are not taking care of the cost. It will not be part. Like you did here, the profit. It's only the two. The original cost is not part. I hope it's okay. So when you want to get the NCI share of the profit for the year, come to the NCI table. The fair value of the NCI is not part, that is for the cost. But the share of profit and any impairment means that that is their share of profit. I hope it's okay. So you add that one, and that is okay. So how much would it be? 278 points. Okay. 278.0.
Maybe say the NCI share.
No, this 383.4 minus 50. Hey. So the NCI share of the profit 2.36. So the smartest way to get it is just come to the NCI table. Don't pick the fair value. Pick the share of the profit, and if there is any impairment, it's PUP. Pick that one. But the PUP has even been taken care of before the share of profit. So it's only the share of profit and the impairment. Then you are good to go. Then the total comprehensive income. The total comprehensive income. You check the NCI financial position in the question. Check the NCI financial position in the question. The revaluation surplus. The gains on the land or the revaluation surplus, which is here. Check whether the NCI has any portion. Does NCI have a portion? Narrow limited or other comprehensive income for the one. You get it? The income statement. Gain on the land, which is part of the other comprehensive income. What is it? So narrow limited dash. So it means that narrow doesn't have any other comprehensive figure. If that is the case, it means that the figure which is the profit for the year will be the same as the total for the other comprehensive income, the share. But if it has other comprehensive income, then that will give another portion. Do you get it? What you are saying is that if we added here for the subsidiary, it means that the subsidiary had other comprehensive income. Okay. So if I'm adding 100, that means that the 100 belongs to the subsidiary. Then when I come here, share of the total comprehensive income, then I'll write it 278.06 plus the portion of the 100, which belongs to the NCI. So the portion of the 100 that belongs to the NCI will be how much? So other comprehensive income for the NCI will be the percentage is 20% of, right, of the 100. So which will be 20. So I would have added 20 to this. No, normally the other comprehensive income is valuation at the time. Yes. To be valuation at the time. Okay. You get it? So we just add it and it is okay. We add the 10 to this and 288. But since it doesn't have any other comprehensive income there, it means that there will not be any share for NCI for other comprehensive income. Because we don't need, and you cannot share the parents' loan to them. So only the parent has other comprehensive income. So it will not be given, that will not be given to the NCI. So the same amount which is for the profit for the year will be the same for the total comprehensive income for the year, for the NCI. I hope it's okay. All right. So here we are not going to add anything. So when you add all of this, then you get the total and get the total here. The total for the year, you just subtract this one, 278.06 out of it. And that one will be the good share of the profit. I hope it's okay. So if this one is 10,000, just subtract the 278. And the remaining will be the good share. I hope it's okay. Then if here will be, it means that it's going to be 10,500, right? 10,500 is because of national comprehensive income. The total comprehensive income will be 10,500. Then that one will also subtract the 378. And how much is it? It's about 3 million. Main fancy. Notwithstanding, the principle is what is important. Because time, of course, only the idea they also into them, yes, and go and update it as such.
Essentially, if you are and then you get your profit for the year, and then you get your other total
For the year.
then
Then you just subtract this one to get the other section. Subtract to get the other section. So some of them can be added as a this one 15, 12 is going to be 27. This one is the same 2,000. This one is going to be 800. Loan notes will still be 3,000. The current liability 16,800. So you are just adding and subtracting. It's not in it. No, 500 rand. 800. Sorry. Yeah. So you can be doing it. This is not anything which is difficult. Maybe that's what you do now, because we can't do that. But that's fine if you are fast. Sometimes you can, and you want to do it. You can see that all the additional information is not related, and you want to be fine. But I don't want you to put your hope in this one because it wastes the time. It will waste your whole time. Job will be. Is there any question? Any question? It is very important that you understand how it goes. So if it is only one portion, just do that portion. Make sure intergroup is there, the late PUP is there, any fair value adjustment, and there's what do you call it? Profit element or depreciation or whatever. You have to calculate it and eliminate it. If you have the intergroup, PUP, intergroup again, fair value adjustment, depreciation. To the revenue measure. 104, 500. And you take 78, 8, okay. Which means that you are getting a gross profit of 2,565,7. Then the distribution 2,000 brackets, 6,000 brackets. The goodwill impairment is also brackets. 159. 3.3. Okay. The profit from associate is positive figure. The finance cost 100 negative figure. Then you get what? 1772 points. Okay. Then the income tax. What is the name? Income tax. Divided by 4, such. 4, 4, 2, 2, 3. Okay. And then I'm also here. Then this one will be 500 as the gain. So we subtract profit from the year out of it. We get say 125.12589. The way now we have another 2, 7, 8 point. There is a second missing. Again, if you put it up in your 1, 2, 5, 9, 0 point. No point, 0, 0. So you subtract this one from it to get the profit for the group, right? Subtract the 2, 7, 8 point 06 to get a profit for the group. 1, 2, 3, 1.94. That's what we are. And now we have a family, no anti-tax comprehensive. 125, 90 plus that, it will be 13,090. 13,090, we subtract the same 378 out of it. 1, 2, 8, 1.94. We are just sharing the group profit. That is a hard one. Still, we have a couple. For computer, we are not getting. Notwithstanding, the principle is what is important. The principle is what is important. Did we add, where is it? Oh, sorry. This fair value is supposed to be added to the fair value on the assets held for is supposed to be in the income statement too. Let's go to the additional information itself. It's supposed to be here, it's supposed to be here. But within the surplus, any surplus must come here. So the 300 is supposed to be part of it. The gain on, not on the land actually, you can have a new line. Let's check the additional information which talk about held for sale, which is 300. So you can have the gain as a new line. Gain held for sale. So that it will not be part of the land valuation. So this one is 500 and this one is 300. So 300 will be added to this to make it right. I hope it's okay. There was land revaluation which they have catered for, but the held for sale increase in it was not catered for. So we have to take care of it in the other comprehensive income. But if you want to add it to the land gain, fine, that is also good. But maybe this is a separate one. As for here, it has been taken care of. Okay. So it means that this figure will change, the comprehensive income figure will change. But for the profit for the year, it will be the same. I guess we have to stop and continue. Maybe we'll send the solution to you today now. So, no. And if you have any question, you can ask that. Whilst we are reading and you have a question, we can answer. Maybe if you put it on the platform, we see it and you answer at the laptop. Or I will be interested in that. So let's try to do the other standard and go through the standard small and come back and do the ratio and the final analysis. I have sent you another, which is the corporate reporting question. I want us to, because the ratio has been coming, time without number, and the other certain for corporate. That question, which is a vertical analysis, came in. So we have to look at how we can also go about it, so that it's not going to be like a shock. Then you don't know anything about the vertical analysis. We also have horizontal analysis. So you try to bring the two together and see how maybe in your time the horizontal will come or the vertical will come. So you don't have any cause to complain than to pass. Okay. So let's go back to the question and try to look at one or two standards, especially those that we put into, so that it will be simple for us. But we can go through some of them, an overview of it. And it is okay. It will be open our house. One to us also as I never. Over the other. I said, oh, but please, you have to go over it. You have to go over it. You still be any kind of accounting about it, but you can You have to start writing so that it will be familiar with you kind of. Okay, so let's look at some of the standards. I guess we have done majority of them, so we'll be discussing or something. But those that we do not treat, let me look at it so that at least we can have. Okay, let's do the IS 21. That is question 5C. Question 5C. No, the mock question. The mock question. The mock question. 5C. But I remember, and I'm going to So we did not do the IS 21 in class, and I'm here. You can follow it. That is the effect of changes in foreign exchange rates. Effect of changes in foreign exchange rates. So this standard is just talking about how to account for foreign exchange transaction in the business. And at times you may even have a subsidiary, which is also in a different country, and their currency is different from the one that you are also preparing an account. So please, you have to go and read functional currency. Functional currency. Functional currency and presentation currency. What do you become? But the only difference is that the functional currency is going to be the one that the entity record its transaction. The operational currency. So if they sell and buy items in a particular currency, that would be the functional currency. Then, if they have to do the presentation, it may be that that company is a subsidiary to another company. If that is the case, that means that the presentation currency will be different. So if this is a subsidiary and there is a group also having its establishment in a different country, it means that how they present their financial statement is supposed to be in the currency for the group. Right? But within that component, the currency that they will be using is the functional currency. That's pertain to what they do. So just go and read around it. There is a criteria to choose which of them is the functional currency. You have to get that one. So that. Then when it comes to the effect of changes in the foreign exchange rate, we have monetary items. And non-monetary items. So normally the monetary items are those items that you have to exchange with almost the same value at the end of the accounting period. In any of them, the initial measurement is supposed to be the spot rate. The spot rate. The spot rate is the rate at which the transaction took place. And the rate, as at that time, that the transaction took place is the spot rate. And we are saying that those monetary items are those transactions that you have undertaken that you have to pay the same amount at the end of the accounting period. So if you are owing somebody payable, that means that you have to pay the exact amount at the end of the period. And that is monetary items. It's part of the monetary items. So, example of them is cash, or if you owe somebody some check, that is one. If there is any trade receivables, if there is any loan or any trade payables, these are monetary items. You have to pay the exact or maybe a smaller amount, which is right. Then the non-monetary item is basically non-current assets. Non-current assets. So the loan will be part of the top here. If it is receivable loans or payable loans, it doesn't change it. Then inventory. Inventory is also part of the non-monetary items. These items will not be translated at the end of the reporting period. Okay. So if it is the initial measurement is at spot rate, but the subsequent measurement depends on whether it is this or that. Depends on whether the item is monetary item or non-monetary item. So the subsequent measurement, if it is monetary item, the subsequent measure is the closing rate. The closing rate. So if you owe me now in pounds, but you are using CD as your functional currency, that means that when the time is due for you to pay, you pay the pounds. It doesn't matter what rate it is there. So you use the closing rate to pay me back. Do you get it? So that is for the monetary item. So let's assume that maybe we UK now more Ghana. And the exchange rate, how much is it now? Let me say 16. 16 Ghana per one. But only one will be given to you, depending on which. So the rate that will be given will only be one. Okay. Then I gave you a loan of a pound, say 20,000 on 1st January 2022. So this is a spot rate. Okay, the date to be given, this is on 1st January 2022. Then you are paying me back on, let's say, 30th June 2022. So as at 30th June, the rate was, let's say, 12. But let's assume that it's 12. Okay. So if I give you the loan as at this time, then you have to state it in your books earlier, then you pay me later. So at the initial, then the value in your book for the loan that I've given to you, so you account for the loan, but not in pounds. This one is in pounds. You account for the loan in cedis in your books. Okay. So how much will it be? That means I have to translate the 20,000 pounds into your cedis. Okay. So if that is the case, it's going to be 20,000 times 16. I hope it's okay. I can also give you 0.something. That means that when you want to get it, so what do you do? You divide. So it depends on how the rate is stated. So you have to know which one. And it will be how much? 20 times 16. But 120,000. Okay, so this is the initial method. Then you have to pay me on 30th June 2022. As at that time, you have to know how much you are supposed to pay me. You have to translate again because you cannot give me that 320. Yeah, so you have to give my pounds of 20,000 pounds to me and repayment. Okay, it's going to be you debit to your bank account with a figure, then you credit the loan, right? In the statement of financial position figure. I hope it's okay. So when you're doing the repayment, you have to know the amount that you have to pay me. So how much are you supposed to pay me? I have to get my 20,000 times 12, right? So you are paying 240. So instead of giving me the 320, you are giving me 240. I hope it's okay. Do you get it? So it means that our company, like your company, has gained. Because initially the cost of the loan was 320. And now when you are paying it back, you are paying 240. I hope it's okay. So that change or the difference, which is how much? 80,000 will go to profit and loss. Profit or loss account. So it will go to the income statement as gain on exchange, foreign exchange. If it is a loss, if you are paying more, the rate has increased to about 18 or 20, it means that you will be paying more. So it will be a loss. I hope it's okay. So it also depends. If it is also receivable, if you are supposed to receive 320 at the beginning, but at the end of the accounting period, you are receiving 240, it means that you are losing. Do you get it? So you have to understand the differences. So it's going to be profit or as for that, to go to the profit or loss. So if within the payment, then you are going to debit the loan account with that figure 240. Then we're going to credit the bank. $240. But the difference is a gain. But in the books, it means that this one is supposed to be there. So that entry must also be done. Because if I do the double entry like the T account, so if it is loan, at the beginning, the bank was here, 320, right? And another one, loan, 320. And if you are paying it back and you are paying the bank, so the loan will be here, 240, right? So it will be loan the bank here, 240. But there's still difference in here. So that difference, which is going to go to be at that of the 80. That means that there's a gain on the loan. I hope it's okay. So that is what you have to do. The loan gain there as a profit, kind of an income. If it is a loss, it means that it's going to be here, it will be added, which you have to pay. I hope it's okay. All right. So that is for the monetary item. Monetary item. Monetary item. So you have the spot rate and the closing rate. You have to always use the closing rate when you are paying at the time of payment. You have to use the closing rate. But if it is non-monetary items, which is the PP or non-current assets and the inventory. In the inventory, it will be the bonds, the loan here that didn't have monetary. You have to pay back. You have to pay back that amount, the same amount, and all of that are monetary. But if it is non-monetary item, maybe we purchase a motor vehicle and it is in foreign currency. That motor vehicle acquisition is supposed to be translated into the current, the presentation currency as such. Then later on, if you have to depreciate or those kind of things, it will also be there. So let me start. If it is non-monetary item, the initial, the same thing. The initial will be a spot rate. The initial will be a spot rate, and the subsequent measurement will still be the spot. The subsequent will still be on the spot. But if there is any adjustment, like the PP, there will be revaluation. There will be those impairment, all those ones, adjustment that comes in, or you may use the fair value, or if it is inventory, you account for it at cost initially, and the subsequent measure may be at net realizable value. As at that time, then, if there is any adjustment, you use the rate, the current rate. At the transaction time, the current rate at the transaction time. At the transaction period of the transaction time. So when it happened, what was the rate as at that time? That is what you have to use. I hope it's okay. So the question here in the mob is the non-monetary one. As for the monetary one, it's simple. And any change, if it is a gain, it's supposed to go to other comprehensive income. Not like this one. You see that the treatment went to here, but this one, the treatment, the gains to other comprehensive income. If it is a loss, the first one goes to where? Here. like we are treating the PP. Eh? We are treating the PP. So if there has been an increase before, or if, I mean, you know that one. So that is how it goes. So let's use the one in the question to solve it, so that you know the gain or the loss on that asset that was acquired. So let's read it. Anyone to read it?
At first, I just went to it. Having the functional currency in the city. What a property in the local for being 40 million. There's a property had a 20-year before like no residual value estimated.
So the cost was given of
40 million.
40
Million.
okay, billion in certain words. Years.
Yes.
Okay.
Is the
Years. Alright. Okay.
The property had a 20-year
And the useful life is 20 years. Okay.
On 31st July 2019, the property was revalued to 45 million each.
The age 45. Okay.
Exchange rates were 3rd April 2018, 1.32 each to 1 cedi.
1 point.
1 cedi is to 1.32 each.
Okay.
And August 2018, first August 2018 was 1 cedi is to 1.25 each.
Mm-hmm.
And then 1st July 2019, 1 cedi was equal to 1.125 each.
Okay.
The five, in accordance with IAS 21, the effects of changes in foreign exchange rates, and IAS 16, property plant and equipment, how much should be recognized in statement of profit or loss and other comprehensive income for the year ending 2019?
Okay. So we bought the asset on 1st August 2018, right? So what will be the initial cost? And as it is property, you have to, the initial cost is supposed to be on cost basis. So the fair value will be the presentation currency as in cities, not in the DH. Okay. So we have the cost of the property. And the cost, let's calculate it. It was 40 million DH. And the DH to city equivalent is 1.32. Now the date that we are part as the first initial cost. The initial cost. So if 1 is equal to the normal calculation, if 1 is equal to, or if 1.32 is equal to 1, then what will be the 40 million? 10 million. So the 40 million over the 1.32 times 1. On the 1st August 2018, and the rate at 2018 is how much?
The first one was 1st January 2018, and the second one is 1st.
The British was on August. Oh, okay. 1.25. Sorry. Okay, simple. So the value is supposed to be 32. 32. That would be 32 million dollars. That would be 32 million dollars. Okay. So it's in millions. 32 million dollars. Any question with that? That would be the cost. The cost of the asset as at the time that we purchased. Do you understand? I haven't answered. We bought the asset at 40 million DH, but our currency is supposed to be in cities. how the functional currency is supposed to be in cities. So we operate all our activities within cities. So as we bought, we cannot be using two different currencies in our financial statement. We have to pick one. And one we have chosen that is going to be cities. So you bought an item at 40 million DH, right? And as at that time, what was the rate? So you have to compare it with the rate. There is going to be rates given to you. So on 1st August 2018, so this one is on 1st January, this one is on 1st August. So it corresponds with the 1st August one. Okay, so 1st August 2018. I hope it's okay. And if 1.25 is equal to 1, what will be 40? So we get 32. But as you saw it, you are supposed to get a lesser amount. Because this one is bigger than this one. So if you get more than 40, it means that you are getting it wrong. Good things also. And this. Okay. So that is the cost. Then you calculate for depreciation. So this one will be what will be in the books. Then we depreciate the item or the property. So 32 over the useful life of 20 years will be, and our accounting year ends at where?
July.
So that will be for 1 year, right?
So that will be 1.6.
So times 1, but 1.6. 6. So the carrying amount as at that day is supposed to be 30.4. Okay, 30.4. So that is the carrying amount. I hope it's okay. Is that okay? The depreciation is for 1 year. You have to check it is for mutual units. That was 1st August 2018. And the accounting year in the person supposed to end at 31st July, so the following year. That will be for 1 year. And that year, we said that anytime that you want to revalue the asset, you have to know the carrying amount and know the revalued amount and compare whether it has been valued upward or downward. So as at this time, what is the carrying amount? This is the carrying amount. I hope it's okay. Then it was revalued. Revalued. So the revaluation is supposed to be how much? The asset was revalued to 45 DH. You saw that? It was valued to 45 DH. As at 31st July 2019. And as at that time, what was the rate? 1.25. 1.125. Sorry. 1.125. Yeah, okay. So we want to still translate. If 1.125 is equal to 1, what will be the 45? So 45 over 1.125 times 1. You get what? 40. How is it? 0.7 here. We have 40. So the asset will be revalued to 40 million. I hope it's okay. It will be revalued to 40 million. So the carrying amount was 30.4 and it has been revalued to what? 40 million. Is there any revaluation surplus or gain or a loss? There is how much? 9.6. That is revaluation gain or gain on revaluation. Where will it go? Other comprehensive. So this one is not going to be like the first was 32, the last was no. You have to calculate the depreciation, know the carrying amount and compare with the new value. So how is it? So if it is inventory, you have to calculate the initial cost of inventory is cost. Or the initial value of inventory is cost. You have to get the cost. Then the subsequent measurement will be the lower of cost or net realizable value. Right? So the net realizable value may be given to you in different currency. Compare it with the initial cost, and know which one to use. If there is any change, it goes to the. As for stock, it will be in the income statement, so you have to know. But for the PPE, it will go to the other comprehensive income. I hope so. Investment property can be whichever other asset can be in the same thing. So if it is investment property, the investment property, any change in the fair value goes to profit or loss. So if that is the case, the change, the cost will be given, you translate. The fair value at that time will also be given, you translate. Any change will go to profit or loss. Investment property, you know the change because it's for trading. You need to go to here now. Whether it's a loss or a gain. Okay. So again, and now it will be. So this one is simple too. But this one, you just have to translate, and when you are paying, translate again with a closing exchange rate. But this one, when you do the first one, you don't translate unless something happens. So if there were no revaluation, that means that the carry amount will be 30.4 and it will be going. But if there is revaluation, then that you can also look at it to know whether there is a revaluation gain or a loss. Okay. Any question? Any question? Okay. It's a little to be shaken by on. This one? You know what is a Bible. And I can do person. But your question be all.
The requirements were like 2-1.
What does it
The effects of the GDC, foreign exchange and IS, property grants.
because it combines the two standards, that's why, because it's property. And there's also foreign exchange. So a person can come with about 3 or 4 standards. But the treatment, so as we were doing the PP, there was inventory, there was PP, investment property, held for sale, and all of that can come into other terms. But the requirement was that what would be the treatment of
So we were like 40 now,
it is the current year.
now we the PP. Now it's the value.
Yes.
It's the current
Yes.
Then the
So you add this one to that to get a 40, and this one goes to other numbers. You need it. So please, this one can even come in the consolidation. Additional information. The property was revalued, blah, 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 and it is there. As one of the additional information. So what do? Then you come and do the cost, depreciation, that and that, get the question number. Then this one will go to other comprehensive income. That will put it in the other comprehensive income. Then you add that one to the PP. Because this one is already in the books. So this is what you are going to add. Get it? So all the standard we are doing, one of it can come in the other, and so it's not like it's in isolation. But one, yeah, in every send the picture they put. After all, we are not saying get 100%. Get 100%. I want to see another question so that you can move. I see it. Oh. I want to get a list question so that we look at it. Because we do not get it, we have to look at how it is. I'm sending a past question. To the past and look at question 2C.
Determine the amount to recognize the profit or loss and other comparative income with respect to the property for the year when Limited is a real estate development company which has been operating for several years. During the office building of which had a net carrying value of 13.5 million. The cost of it was reached to value the property. No depreciation had been incurred because the expected residual value was more than the cost due to the volume of real estate market. The property became vacant as a result of relocating the company's operations. And on April 1, 2022, the third party, the landlord, was given a 6-month short lease to occupy it. The property's fair value at the time of the value was 16.5 million. When she made a choice, how the company basically
this is it B? It's supposed to be B, or
this one.
Supposed to be
B. Okay. So the part, the B is
yes, this. Yeah, I want the list.
In accordance with IFRS, leases show the financial reporting details of the above transactions in the financial statement of for the year ended July 2024. Fugu Limited operates in the number of dimensions. The following transaction relates to Fugu for the year ended July 2023. On August 1, 2022, Fugu entered into a 10-year lease, agreeing to pay $3 million annually in arrears in connection with the use of a building. The present value of the minimum lease payment was $20.13 million. First project and the leasehold economic life of the owner was 15 years. Fugu's cost of capital was 8%.
Okay. So with the list two, you have to one transaction, but one is accounting for it as a liability, and the other is also accounting for it as an asset. Notwithstanding, it depends on where you are standing. So whether you are the lessee or the lessor. So the one who is giving the asset is going to be the landlord, which is the lessor. Then the one who is taking the asset is going to be the lessee. Okay. But the standard is saying that when you are lessee, that means that you can only account for the asset. You have two ways of accounting it: as operating lease or as a finance lease. But for you as a lessee, you can only account for it as finance lease. But if it is the lessor, he can account for it as whether operating or the finance. Notwithstanding, the finance lease definition was given, but the operating lease was not given. So the other way means that all the other leases are operating lease. So the finance lease is that if all the rewards or the risk associated with the use of the asset is transferred to the lessee, that means that it qualifies as a finance lease. Is that okay? That is the first one. Then, if the period, the lease period, is almost equal to the useful life of the asset, that means that it also qualifies as a finance lease. The standard doesn't want a situation where it's like you're using the asset to do your work and you're treating it as a operating lease. No. That's why the standard is in, so that we all find a common ground to pick there. And again, if the minimum payment, the rent payment that we said, the minimum payment or the contribution is also equal to the cost of the asset. So these are the three criteria that will qualify the asset to be on a finance lease. Any of them is okay. This one, the three can be together as such. Okay. So if it is a finance lease, that is the criteria or that is the definition. Any other lease is operating lease. If the risk or the risk is transferred to the lessee or the reward for the use of the asset is transferred to the lessee, it means that it's a finance lease. If it is not transferring, it means that it's operating lease. I hope you understand. If the useful life of the asset is almost equal to the minimum, the lease period, that means that it's a finance lease. If it is not, it's an operating lease. If the amount that you are paying, the present value of the amount or the fair value is equal to the cost of the asset, it means that it's a finance lease. Otherwise, it's operating lease. I hope it's okay. How to account for operating lease? How to account for operating lease is that, as I told you, for the lessee, you cannot account for operating lease. But for the lessor, you are receiving the amount of money from the lease. If that is the case, you find the total lease, the total rental for the period, and you divide it by the number of periods. So like this one that it says that we are paying for 20 years as a 300,000 or so. That means that I multiply the 20 years. Sometimes the figure changes. So you want to find a common amount, that's why you're using this one for the operating lease. But that normally should not come in the exam, the finance lease, which is important. So with the finance lease, the lessee, you have to account for the finance lease as an asset and also account for it as a liability. The liability in the sense that it's like the person has given you a loan to acquire the asset. So the asset will be accounted for as your own asset. You depreciate it in accordance with IAS 16. Then the liability will be that all the minimum payment, you find the fair value of the payment that you do, and that will be the liability for you. It's like the person has given you a loan that you have to pay back, but you account for it as an asset. With the operating lease, you only account for it as a liability. The payment is like hiring. So when you now go and hire any equipment that you are going to use, and all the reward and the risk are up to you, like the excavator and those kind of things, it's not going to be treated as operating lease. It's going to be treated as a finance lease. So you have to add it to your asset and also add it to your liabilities. Other than that, when you only treat it as a liability, it's going to pass through your income statement. That will be the hiring cost, rental. No. The standard is saying that treat it as an asset and also treat it as what? A liability. So the asset will be, you will see that you write right of use. Right of use lease. So that is an asset. Right of use lease. Or lease right of use, whichever is there. Then the liability will also come as a lease liability. So we have to get how to get the value, initial measurement for each of them. So with the finance lease, if it is operating lease, that one is simple, but in the exams is the finance lease. So the initial measurement is always the present value. The present value of the initial cost or the liability. The initial measurement is always the present value. The present value or the fair value of the cost. So sometimes it will be given in rentals. Then you find out the present value. You know how to get the present value. Like the cash flow, the discount factor, and the present value. That is going to be the initial cost for the liability as asset. Then the right to use the asset is also going to be when there is any additional cost, incidental cost like we did with the financial instrument. That means that you add the initial directly attributable cost to the fair value. So if it is a liability, then it's going to be the present value. I hope so. But if it is an asset, then it's the liability plus any direct cost. That is what I mean. The liability plus any direct cost will be for the asset. I hope so. But if it is only the liability which is given the present value, like the question I read, only the present value was given. There was no direct cost, so it's going to be the same amount. Okay. Then the subsequent measurement for the cost for the asset, we are just going to use this one is the initial. The subsequent measurement for the asset is still going to use the cost model. It is going to continue with the cost model. So the fair value plus the direct cost will be what is going to be used. Then if it is the liability, you use the amortized cost. The amortized cost. So we are going to use the amortized table again here. We are going to use the amortized table if it is a liability. Okay. So let's try to solve the question using that and it is okay. So that standard that came in there. That is November last session, right? Like can come in any form. It could even be in the final account or the consolidation. So please can you read it again so that we use it to solve?
place the mobile conversion.
Okay.
The following transaction will make for the year and the event in March 2023.
Okay.
On August 1, 2022, who entered into the 10-year lease and going to pay 3 million rupees annually in arrears in exchange for the use of a building. The present value of the minimum lease period was 20.1
So this time the present value was given. So you need not to go and find the present value using the payments. So the present value was how much? 20.1, correct. Okay. So we can make it 21 days, right? Million. And the present was at the top. Okay.
That's on first of the 2022. And the useful economic life of the building was 50 years.
So 50 years useful life.
And the cost of capital is
Cost of capital
8%.
8%. Okay. And the requirement is
The requirement is in accordance with IFRS 16 is show the financial reporting treatment of the above transactions and the financial treatment of the building for the year and then the third year.
okay. So when was it? The lease was about. When was it about?
First one, first
First August
2022.
2022, and the financial year ends on
The third year.
21st July 23. So that is 1 year, right? Okay. So you have to account for the assets and you account for the liability too. So the right to use the asset, right to use, which is a lease, right to use the lease. How do you account for it? And you are saying that you are using the fair value plus any other incidental cost or direct attributable cost. And what was the cost on the fair value? That is the present value. I hope it's okay. So the present value is 20. If you take some of the zero out, 137. I hope it's okay. It is an asset. And if it is an asset, you account for it on cost, the subsequent measurement. So the subsequent measurement, this is initial measurement. The subsequent measurement would be that we have to depreciate it. We have to depreciate it. And how many years are we depreciating it?
40 years.
3 years. And the lease period as such. So how much will it be? 2.
What the 2.6?
Let me check this. Okay. Please, you use for the depreciation, you use the lower of lease period or the useful life. So let's check the useful life and so the lease period is what we use because that is where we are getting the use of the asset, not for the whole 50 years. I will be simple. The lease period is for 10 years. That's where we are getting the fair value. So if you are going to use the whole 50 years, the other 40 years, we are not using the asset. So you cannot provide depreciation for that unused period. I hope you understand. Okay. So that is for 10 years. We use the lower of the 3 periods, whether it is the lease period or the useful life of the asset, which is lower. That is what we use. The number of years. I hope it's okay. All right. So how much will it be? 201. So that is the depreciation. And the carry amount will be how much? 1. And it was. So in the books, this is supposed to be the carry amount and then on current asset. So the initial was 20, you have depreciated it, and that is it. Then let's go to the liability side. You are saying that the initial is the present value, which is this one, but the subsequent one is supposed to be amortized. So we have to use the amortized table. So the years, then the balance will start. Then the interest or the finance cost. The interest payment or the finance cost, which is about that. Then the rentals. That is the rentals or the repayment. Then the balance at end. But please mind you, if it is paid, this is paid in arrears, as the person said. If it is paid in advance, there will be interchanging of these columns. This one will come in, this one will come in. I hope so. The payment is done in arrears. That is at the end of the period, at the end of each year. But if it is done in advance, it means that we pay before we charge the interest on the balance. So we have to interchange this one, these two columns. So anytime we say that the payment is in advance, put the rental here and put the finance cost here. I hope it's okay. Yes, sir. Okay, so year 1 or 20, it will end in 2023. It will end in 2023. And the fair value is the value of SAC, which is 20,130. Then the finance cost is what? 8%. 8%. I hope it's okay. So we work 8% on it. 16.4. Okay. Then the renter, how much is the renter per year? So here is going to be 3,000. So it means that they are adding this one and subtracting the payment from it. They are adding and subtracting the payment from it. 1,8,740.4. Okay. Any question? But when we are doing it in arrears, like what the question is saying, then you have to also add another year to it, 2024. You are going to use certain figures. That's why you have to add another year to it. So you bring the opening balance as you do in amortized table. 747.4. Calculate the 8% on this figure. 1,499.2. So the payment is 3,000. As for the payment, it doesn't change. I hope it's okay. So anytime when we are giving a lease question, you just have to get the present value of the payment. If it is given, since this one is only 10 years, I guess that's why the person gave it to us. Other than that, you have to find the 3 million and work the discount factor for each or you can use the annuity formula to get the present value for the 10 years. When you get for the 10 years, that is going to be the present value. And that present value is going to be the liability at the beginning. Is that okay? If there is any other cost, additional cost, directly attributable cost, then you add it to the present value to get the cost of the asset. But this one, there is no other cost. That's why they say that it's also there. Then you treat the cost of the asset as non-current asset. This is going to be non-current asset. The right of use of the asset. You depreciate it within the period, whether the lease period or the useful life, the one which is shorter. You use the useful life or the lease period, the one which is shorter, to depreciate it. That will be in the asset. Then when you come to the liability, you come and use the amortized table. You use the amortized table starting from the present value, move on aside. I hope it's okay. If it is also paid in advance, when it is paid in advance, the first payment, which is the 3 million, would have been done before the future payments. Please get that one. When it is paid in advance, and it says that calculate the present value. So like the 10 years, if it is 10 years for each 3,000, the present value will only cater for the 9 years. Because the present value is calculated on the future payment. So the present value will pick the 9 years. And that one will be the liability. When you want the asset, you pick the 9 years and come and add the first 3,000 that you paid. Is that okay? Because you have paid any cost that you have paid is part of the asset. Is that okay? But the liability will not cater for the first one. I hope it's okay. They are not so dear. But with this question, but with this question, this is how you have to do it. You have to get the present value, which is this. You depreciate the present value, and that will be the asset as such. You use the present value here. The figures are the same. But the question is that how is it going to be treated in the financial statement? Yes, sir. Requirement is there.
Show the financial reporting of the transactions in the financial statement.
Okay. Into YAB, you have to show it in the financial statement. In the financial statement, there, we have the extra, the statement of profit or loss. So what will be in the statement of profit or loss? There is going to be depreciation. The depreciation figure will be 201. How is okay? There is also going to be finance cost. Lease. And that one is also going to be 161.4. I hope it's okay. And then we are using 20. This one is 2023 statements. Maybe it is 2024. I'm using the 2024. And I'll change that. I hope it's okay. So that one will be the income statement. Then we go to the statement of financial position. Statement of financial position. What should it also be there? So with the statement of financial position, statement of financial position, asset, non-current asset, lease, that is right to use. Right to use lease. What is the value? We have the closing as 117, 117. I hope it's okay. Then we come to the liabilities. Is there that we have to get the two? So the non-current liability and the current liabilities. Lease. And there is also going to be lease here. That's why we did the two tables. That's why we did the next one. So what is going to be the non-current will be the second one. The 17, 239.6. Then the current liability is going to be the difference between the two. Or you can pick this one and subtract this one. It's going to be the same. Why? Because this figure, which is 8740, would be paid for a whole long period, less than 9 years, right? But how much of it is going to be paid within 12 months? Because for the liability, you have to be able to classify them between the one that will take more than 12 months and the one that will take shorter than 12 months. No. 18,740.4 is what is left for us to pay. But within the 18, 17 of it is going to be paid within next accounting year, not within 12 months. It will be more than 12 months before you pay that fee. But how much is going to be paid within the 12 months? That is it going to be the difference. So how much will it be? 1.8. So any time that it is in the arrears, due to, if it's the question requires us to do the 3rd year, then you have to do the 4th year too. If it is 5 year, do the 6th year. So the 6th year balance will be the non-current. Then the difference between the 5th, which you have to do, and the 6th will be the current. Or you can also, faster, you can also end here, find out the difference between the two. It's still going to be this. Then you subtract it from there, which will take a longer time. I hope it's okay. I think sometimes if you don't understand, just do what you do. So for this, you have to be able to separate the long term or the non-current and the current. It's not going to be one. So separate it always. Even if it is in another question, do the calculation, separate it. I hope it's okay. Because it can be in the final account, it can be in the consolidation. You have to do it, separate it, and come and put them there. I hope it's okay. But please, if it is in advance, if it is in advance, you end up only once. You end up there. I hope it's okay. And what we are going to put in here is that in advance, the current one is the next payment. The next payment will be in advance. So the next payment will have been the 3 million. I hope it's okay. No, this payment will be the next payment. The rental payment will be the next payment. And if it is in advance, it means that it will be here. It will even be paid in the next month. When you bring the balance, I know here. Because it is in advance. 1st January you are paying. 1st January you are paying. But with this one, you are paying it on 31st December. So if it is in advance, you will end up with only one of them. But the current will be the next rental payment, which is what is here. Any of them is the same figure. So 3,000. What about the non-current? That means that you subtract the 3,000 from this one. Sorry, from this one. So it would have been 15. Let's say 18. 15,740.4. So So this one is in advance, and this one is in arrears. If it is in advance, the next payment you get this one. So you subtract this one from the closing balance, which is there, to get the non-current. The non-current, because the current is the next payment. Then the non-current will be the difference between the two. But if it is in arrears, you have to do two tables or two lines. Then the last one will be the non-current. When you subtract the last one from the first, it will be the current. I hope it's okay. If we're looking for okay, so that is for the lease. It's not going to be long in the question answer. It's short. Any of them will be this one, and you are going to. So it's either in arrears or in advance. If the fair value is given to you, the fair value will start a debt to do the amortized table. And you have to also account for it as an asset. So you use the fair value. But if it is in advance, it means that after the fair value, you have to add the payment in advance. So if it were in advance, it means that we are going to add 3,000 to this one. Yes, that was the initial payment. So if it is in advance, the first one will be paid before the subsequent ones. So the present value will be without the first one. So you add the first one to it before you get the use of the asset, the value of the use of the asset. Okay. Any question? I guess you have to do it for a while and come back and do the other things. Never the young boy. Yeah, kakakra, so the kakra, which will be too good. Please do.